Okay, I think we can start, which is the discussion of the mock paper. Then welcome all of you all for the discussion. Then I guess this will take at least 4 hours. Assumed to be complete within 4 hours, but humble request, which is the stay till until the discussion of the paper. Okay, with that, which is the open thought, you are welcome to the discussion of this 3 mock paper. And when it comes to this paper discussion, and when it comes to this paper, this is as a help the institute has done for you all for students who are going to sit for examination on in next week, which is 22nd June 2025. Then yeah, the paper also shared. Then which is I think maybe the students who may faced this paper last week, which is I think it's on the 12th June it was conducted. Then I think you all have some students may sit for the exam, maybe not. Then this is for all of you all. This is a discussion of the paper to the help for the student for upcoming examination. Then therefore we are really gratitude to the institute by conducting this kind of a session and encouraging the students to do this, and this kind of the discussion is everything on behalf of you. Then therefore take the maximum benefit out of these discussions, and even whatever the questions you all have, you can ask. Then all the the pool of resources are with your lamai. The only thing you have to get through this paper, it's only you have to take 50 marks. It's not, don't target on 50 marks. Then you can go up to the it's a 95, 90, whatever the required marks which make you maximum level for you to gain out of this paper. It's not 50. Then 50 is for you to make sure for you to pass, but the entire balance 50 by taking that, it's up to you. Okay. Then with this all, I will start now how the plan of the paper discussion is going. Then first I'm going with the first question, second question, and the third question, which is in section 1 and section 2. Okay. In that, let me first finish the section 1, question 1. If it is A, B, C like that, in the first part of the discussion, let me complete. Then afterwards, I will come to your questions. Then we will discuss the questions and I will move to the next part. Likewise, by question to question, until I'm not waiting until the end of the paper to answer your questions. Then once we are discussing the questions, you can ask the relevant questions. Huh? Please ask the relevant questions, and all the relevant questions within my capacity, I will provide the answers. And going forward, that's been completing one question and next one. And on that relevant parts, questions, and again next one. Like that, we will do. And any questions you all can put into the chat box. Meanwhile, any questions with reference to the internet connection, the sound audibility of anything, then you all can please talk to me. Because when doing the paper, I'm not looking for your chat box. Then therefore, you can talk and you can please inform me these issues are there. Okay. Then with this all ground rules, we will start the discussion. Then come to here, which is I will share the screen. Okay, then this is the paper. in this paper, which is the main thing, when it comes to now, you have done your pre-scene, you have gone through your pre-scene for your June 2025 examination, but this paper is not tested in the question 3. I need to first tell you all this question 3, it has not tested to the current pre-scene. It's based on the pre-scene issued for December 2024 examination, and already there was an unseen in December 2024 paper. Then same pre-scene, it was taken for this examination, which is this mock exam paper. Okay, then please keep that in mind. The all relevant adjustments with reference to question 3, part A, we will discuss, but you have separate pre-scene for your actual exam which subject to unseen at your exam, and it has already discussed. Then this pre-scene this unseen which we are discussed here, not the pre-scene in your examination. That's the small reminder for you all. Okay. Now come to the paper. This is given, which is a common pre-scene provided for December 2024 examination is relevant in relation to this question. It is applicable. Okay. Then in the paper, all these things you all know, but I will go through the relevant instructions to candidates, which is that you can bring Inland Revenue Act and its amendments and the VAT Act with amendments and relevant gazette notifications, and with reference to these gazette notifications, it should be certified. It should be certified by the institute, and they are it's very effectively they are doing that. Please take this the nitty-gritty is for you to be in the comfort zone at your examination. Okay, and let me come to this with this point number 7, because a lot of students are asking on this matter. The candidates are allowed to bring or use the above permitted publication subject to followings. Okay, highlighting, slide lining and underlining relevant sections in the publications are allowed. Short notes in the permitted publications are allowed only if they are handwritten and are relevant to the particular paragraph or section in the publication which explain that paragraph or section. Then other than that, for short notes, handwritten short notes, you cannot write. Now, for instance, if I have taken in the Inland Revenue Act section 11, which is the main deduction rule, students can write short notes reference to the section 11. But instead of that, you cannot write any case law provisions relevant to the section 11. No. කිසිම එහෙම දෙයක් කරන්න බෑ. Don't do that. Then it is unethical. Then that's why it's very clearly given the relevant particular paragraph for that relevant thing in a handwritten thing you can do, but relevant to the particular paragraph or section. Then a lot of students ask on this handwritten part what we can do. You can't do anything other than prescribed in here in the instructions to candidates. Then this is as per your actual exam paper, these instructions are same and similar. Therefore, please note that. Okay. Then which is in the question 1, in section 1, question 1, there is I just need to go through the paper. In that part 1 and part 2, the two parts of the questions are there. Then for the first part, it's for the 15 marks. And for part 2, it's for the 10 marks. Then question 2, it is for 15 marks. And in question 2, part A 15, part B, it's for the 10 marks, altogether 25. And when it comes to section 2, in question 3, mentioned in the section 2 of the paper, then it's based on the common pre-scene issued for December 2024 exam and the relevant adjustments and the question, and it's 30 marks. And after that, you have to, for the written part of the answers, it's a part B for 14 marks, and part C is for the 6, altogether 20. And as the annexures, as usual, you all have the relevant double taxation treaty as the annexures in articles, and the action verbs critical. I'm always referring to the action verbs, and without that, which is the resilience of this paper is difficult. And yeah, this is the common pre-scene for December 2024. Then as when it necessary, I will refer this one also. Okay. Now this is on the entire paper which it has given. Then in a methodically order, I will start from the question 1, part 1 and going forward. Okay. Then come to the requirements of the question. I'm normally going for the requirements of the paper and coming to the facts. It's my method which I'm doing, which is I thought it's a good method for the exam, because when we are reading the requirement, we know what the examiner has asked. Then based on that, our mind is straightforward to the facts of the case in line with the requirement. Then that's my approach. Then I'm doing here the same thing, but Lamai, if you are not familiarized with that, then please do the free method, what is matched to you. Okay, I'm not telling that it's definitely you have to read this and do like this, nothing. You are totally free to apply whatever the convenient method of you. Convenient method to you. But in my case, I'm going with requirement, and normally I'm looking for what is the marks allocation. Based on the marks allocation, I need to decide what's the time I should allocate for each and every part of the question. And that's how which is the training frame in my mind for the question, and afterwards I'm coming to the facts of the question. But it is not, it's a compulsory for you. What you have, Patrice, what is convenient to you, please do that. Okay. Now come to the question. What are the requirements? The advice. You have to advise whether MTGS requires to pay income tax in Sri Lanka. Now you know, rather than the final answer, Lamai, I really need to come for these things. Now, what's the first action verb in the question 1? It is the advice. Now, when it comes to action verb checklist, then advice, it is in the tier 5, in the tier 5, in evaluate. In tier 5, the advice. Under particular action verb of advice, what you have to do? Offer suggestions about the best course of action in a manner suited to the recipient. Then in here, if you are providing advice, you need to suggest the best course of action. Then in a manner suited for the recipient. Now, what's that mean? There is a situation given for you. For that situation, you have applied for what? You have to provide the best solution for that one by taking the scenario, and always, now this is SL3. Then you have to apply the particular provisions of the Inland Revenue Act, and the scenario is there. You have to provide the conclusion, the best course of action you have to tell. Then this is the action verb, the advice, which is in the tier 5 evaluation. Then based on that, we are going to do our answer. Then there is a entity or a name called MTGS. Then we need to look at what is this MTGS and its income tax liability, how we are going to ascertain whether this MTGS is liable for tax in Sri Lanka or not. Then now it's given here, support your answer, see it in statutory provisions of the Inland Revenue Act. Now you can see this is a regular format, which is the actual exam paper also, which is the, you need to answer for this one, the how to answer it has given. Then for you to obtain this 5 marks, then 5 marks, it's for a 1.8 minutes, it's 9 minutes you can utilize. In this context, then you need to write your answer in accordance with the requirement. What's the requirement? It is advice how you are going to provide your advice as per the provisions of the Inland Revenue Act and its amendments and relevant articles of the double taxation treaty between Sri Lanka and Poland. Now, the double taxation treaty is Sri Lanka and Poland. Then you need to look at, according to this treaty provisions and the domestic law provision Inland Revenue Act, then whether this MTGS shall pay tax in Sri Lanka. Not only that, again, there is another paragraph given here. Your answer should include an analysis of implications under all different types of the permanent establishment. Now in your answer, you have to do main 2 things. The first main one thing you have to do, you have to advise MTGS required to pay tax in Sri Lanka. For that, as a tools, you have to use the DTA, which is a domestic law provision, and second one, the double taxation, the relevant articles of the double taxation treaty between Sri Lanka and Poland. Under that, this is for double taxation treaty, the second application. In that, you have to very clearly analyze what is the permanent establishment mentioned in the double taxation treaty. Very clearly, you have to analyze the implications. Then in the Article 5, in each and every double taxation treaty, Article 5, it is because double taxation treaties are designed in under 2 conventions, which is the UN and OECD models. Then in that, normally Article 5 is for the permanent establishment. In that permanent establishment, then permanent establishment article, you need to analyze the different types of the permanent establishment as required for MTGS. And you have to conclude your answer. Then this what for 5 marks you have to do. Then B, which is, I will take a separate color. Then for B, what you have to do for 6 marks, you have to do compute the income tax liability of MTGS in Sri Lanka, including remittance tax payable for the year of assessment 24-25. Then computation part of this company, then always you can see if you have mindfully, if you have looked into this, the first one is linked to second one. The first one is linked to second one. Why? Because it's for MTGS, we have to compute the income tax liability. Then for me to compute income tax liability of MTGS, then for the first one, anyway, we have to conclude even entire activity, what they are doing in Sri Lanka, or a part of activity, it should be liable. Then this is combined. And C, what is asking C for the 4 marks, then it is asking on the, as the tax consultant for Carewell Hospitals PLC, we will look at what is this, critically evaluate. Now this is a compute and this is I think there was a connection issue. Suddenly it has happened, then sorry. Then we are here, which is the action verb is evaluate. Then in that we have the sub thing is evaluate. In that to determine the significance of by careful appraisal. Then evaluate in the tier 5 what it has the main thing. Formation of judgment and discussion about the value of methods, ideas, people or products. In that, you have to evaluate to determine. If you are determined for something to determine, then you should have to provide a clear guidelines. Then here, the determine the significant by careful appraisal. Then if you need to determine something and you are communicating it, you should provide a conclusion. Then therefore, you have to do the careful appraisal. What you carefully appraise? The given facts of the case. Then how you determine given facts? Based on the provisions of the Inland Revenue Act. By taking these two combinedly, what you have to do? You have to provide a particular decision, particular advice to a given practical scenario. Okay. Now it's for the 4 marks. We will look at what it has asked. What it has asked for the 4 marks here. Evaluate the accuracy of senior accountant's position with reference to the relevant provisions of the Inland Revenue Act number 24 of 2017 and the double taxation agreement between Sri Lanka and Poland. Now we don't know what we have. We know we have to evaluate something provided by the senior accountant. Then we need to carefully appraise whether his position is correct or wrong. Okay, that's for the 4 marks. This entire for the 15 marks. Now quickly come for the details given in the question. Now I know what I have to do. Then with that in mind, I'm coming to the facts of the question, but no harm if you really need to read the facts of the question, and after that, if you need to come for the requirement, then it's okay. Come to this, the Meditech Global Solutions SPZU, which is a MTGS. I'm using the name MTGS, is a company incorporated in Poland, specialize in the, now come to this, company incorporated in Poland. While reading the question, the relevant information I need to come. MTGS, now according to this, the company incorporated in Poland. If it is so, if a company incorporated outside Sri Lanka under residential status of a company under section 69 subsection 4, then this is resident company or non-resident company. This is non-resident company. This is non-resident company. Done the first point. And specialize in developing and deploying customized hospital information systems, HIS, for healthcare providers globally. What's their principal business activity? The principal business activity is specializing in developing and deploying customized hospital information systems for healthcare providers globally, not for Poland, but for entire. They are providing the worldwide, which is the developing of this particular HIS, which is Hospital Information System. Then MTGS has implemented cloud-based patient and billing system for major medical institutions across Europe and Asia. They have already established with the cloud-based patient and the billing systems. Okay. Then that is for the first paragraph. And second one, Carewell Hospitals PLC, CHPL, a leading hospital chain in Sri Lanka. Now this is what? This is a resident company. This is a resident company and entered a contract with MTGS in July 2024 to implement a fully integrated HIS platform across its network. Now what has happened? there is a non-resident company incorporated in Poland. Then this non-resident company has entered with a contract, particularly a service contract with a resident company in Sri Lanka, which is the Carewell Hospital PLC. Then next, the system is hosted on MTGS servers in Poland and accessed by CHPL via secure mode connections from Sri Lanka. Because they are having this one, the usage of this, they have cloud-based system, then they have servers through this mechanism, then which is Internet of Things they are using, then from this, then they can CHPL access to their servers, and after with the systems they can integrate it. Okay. Now come to next one, which is the project scope and execution. Between 15th August 2024 to 2024 and 20th February 2025. This is the timeline given. There is a timeline given. 8 MTGS employees, technical and implementation specialists worked on site in Sri Lanka to configure, deploy and customize the HIS, which is the Hospital Information System. They were based at CHPL's main office and various hospital branches during the rollout. Now, accordingly, which is CHPL, its a main hospital is there, the branches around the country there. Then in that, this team of the 8 employees who stay in Sri Lanka between 15 August to 20th February 2025, then they are going to stay in the as a place to do their particular, the developing of the software, this particular service. They are located in the main hospital as well as the branches around the country. That is for this explanation given in the paragraph Roman 1. Then next, post-diplomat support and merchant integrations were handled remotely from Poland. After implementation, the kinds of the support services, were handled remotely from Poland. No further employee visits occurred after 20th February 2025. Then this is the last day of this 8 employees. And after that, it's linked to here, no employees came into Sri Lanka. Then it's on the paragraph number Roman 2. And in 3, free structure agreed with CHPL. Now you can see the Poland company, non-resident company, providing the services to the resident company. Then resident company shall pay the as per the agreement, resident company shall make the payments to the non-resident company. Then that fee structure it has given. Now let me come to here. A fee structure agreed with CHPL. HIS system setup and customization US dollar 450,000. It's a lump sum. Lump sum, it's a lump sum. එකවර ගෙවන්න තියෙන. It's a lump sum payment. Then on-site training, US dollar 60,000. Annual license and maintenance, US dollar 80,000, payable in April each year. Now please read the information given carefully. Annual license and maintenance, it has payable in the April in each year. Now, this contract period, it was given as per the question. 15th August 2024 to 20th February 2025. And if it is so, this payable amount, now in here it's given all the details for the 31st March 2025, and again for the computation perspectives, we have to do the calculation for 24-25. Then come to this one, this annual maintenance fee. For this one, Lama, it's payable on April each year. Now the question is, if this is coming in April, then it's annual license and maintenance. For me to receive, if I'm this Poland company, for me to receive this annual license and maintenance income, I should maintain this system, the HIS, Hospital Information System. But now I'm in a year of assessment or a financial year ended 31st March 2025. Until such time, it will be completed on 20th February 2025. Then for me to maintenance that particular liability, and it is arising from the next year onwards. It's not applicable for this year. Then by reading the information, you have to extract, you have to take out the relevant information for your computation. And the fourth one, expenses relating to Sri Lankan operations for the financial year ended 31st March 2025, including head office expenses incurred in relation to its operations in Sri Lanka during year ended 31st March 2025. Now the breakup of the expenses given, including the head office expenses. Then the description, head office means from the Poland company, what they have incurred on this local service activity, what they have done. Then the description and the amounts. Now you can see this is given in LKR. And this income, it has given in the US dollars. Income given in the US dollars, and the expenses given in the LKR. Then please mindful when you are applying these figures. Then salaries for the months worked in Sri Lanka, then is 19.2 million. Cost of airfare traveling between two countries, 4 million. This is for all 8 employees. It's given. It's for Sri Lankan operation, then it's including all. And local traveling expenses for hospital visits. Now you can see for their rollout activities, not only for this particular head office, but all other hospitals they have to go. And staff accommodation and living allowance, which is the cash benefit it has given to them. Executive and general administration expenses. Lamai, this is not the head office expense, huh? This is just like other administration expenses which incurred. And head office overhead allocated to Sri Lankan operations. This is not the amount which actually incurred, but which is the allocated amount. And server hosting cost in Poland apportioned to Sri Lankan operations. Now you can see without that they cannot do this business. Then it's given, which is the system is hosted on MTGS servers in Poland and accessed by CHPL. Then for this anyway, the servers we have to use, then that relevant cost based on the our part of the operations in Sri Lanka, it has allocated. Then the note one is relevant to executive and general administration expenses. Then here, as per the ledger details of executive and general administration expenses, it includes followings: donation made to project of Ministry of Higher Education, 650,000. This is donation, which is when we are doing the calculation, it should be disallowed. Provision for administration expenses, 850,000, it's a provision. Then provision should be disallowed. And other executive and general administration expenses incurred to produce income of the project, which is 6.8 million. Then it is 8,250,000. Then in this 8,250,000, then it's 650,000 plus 850,000 plus 6.8 million. Yeah, then it's totally 650 plus 850 plus 6.8. Yeah, then it's 8.3 something it is coming. Then this is the total breakup. This is the total breakup with reference to small thing, with reference to the application of the general ledger details of the general executive and general administrative expenses. Then note 2, all cash and non-cash benefits mentioned above are subject to relevant taxes and employment income. Now you can see in this question in here, the salaries, cost of airfare, local traveling expenses, it's not the employment income. Then staff accommodation and living allowance. Now these things, even cost of airfare, we can define it for the official perspective. Then if I have taken then salaries and the living allowance, then it is given all cash and non-cash benefits mentioned above are subject to relevant taxes and employment income as per the provisions of the double taxation avoidance agreement, Article 15, which is a dependent personal services. Then anyway, whatever the paid to employees, it will be subject to tax. Okay. Then next, further, Carewell Hospitals PLC, CHPL, intends to enter into technical service agreement with Meditech Global Solutions, MTGS, with effective from 1st May 2025. Under the, let me take this part separately. Then this is for this is for that the 4 marks. Then let me take this separately and I will take this. And assume $1 equal to LKR 304, extracts of the article of 4, 5 and 12 of the agreement between the government of the Democratic Socialistic Republic of Sri Lanka and the government of the Poland. It is given in the Annex 1 for your reference. Now all the details it has taken. Now come to the requirement here again. Now what you have to do, you have to advise to on behalf of the advise whether MTGS shall liable to pay income tax in Sri Lanka as per the provisions of the Inland Revenue Act and as per the provisions of the Double Taxation Treaty. Very specifically, when you analyze in the Double Taxation Treaty relevant articles, then you have to analyze the PE exposure. Then now come to that for the 5 marks. For this one, it's very clearly what are the points you have to taken from the case. Then it is the Poland company, which is the MTGS. It is the company incorporated outside Sri Lanka. Now it's been what? It is a non-resident company. Then if it is they are a non-resident company, then for that non-resident person, if that company is earned income in Sri Lanka, then that person has to pay tax in Sri Lanka. Then we need to identify what is the source of payment of that non-resident person. Then when we are identifying the source of payment, the Inland Revenue Act, we have section 73. Then under section 73, if there is and section 4 and section 73, I need to link. The section 4, it has very clearly mentioned, if there is a non-resident person, income arising in or derived from employment, business, investment or other, shall be liable to pay tax in Sri Lanka. And the sources of payments to non-resident person, it has defined in section 73 of the Inland Revenue Act. Besides that, you need to look at if there is double taxation treaty between Sri Lanka and the respective country, then our domestic law, it has very clearly given the application of the section 75 subsection 2. What it has given, if there is a double taxation treaty, the double taxation treaty will prevails the exceeding the provisions of the domestic law. Now, accordingly, in our case, we have the double taxation treaty. Then, the now domestic law provision we have explained, discussed. Now we need to go for the double taxation treaty. Accordingly, we need to look at whether now for company to pay tax in Sri Lanka for business profit, what's the main requirement to be satisfied? The company should create at what? Permanent establishment in Sri Lanka. Now, according to the Sri Lanka and Poland double taxation treaty, you have to look at whether this is a PE or not. Then come to the Article 5 of the double taxation treaty between Sri Lanka and Poland. In here, what it has given. This is that the permanent establishment. In permanent establishment, what's the first thing? The purpose of this agreement, the term permanent establishment means the fixed place of business through the business of an enterprise is wholly or partly carried on. Second one, the term permanent establishment includes specifically place of management, branch, office. These are the examples. And next one in the paragraph 3A, it has given on the activity PE based on the number of days, which is a building site, a construction, assembly or installation project, a drilling rig or ship used for the exploration or development of natural resources, including supervisory activities in connection therewith, but only where such site projects or activity continued for the period of 6 months. And in the 3B, the furnishing of services, including consultancy services by an enterprise to an employees or other personnel engaged by the enterprise for such purpose, but only where activities of that nature continue for a same or similar, which is a connected projects within the contracting state for a period or periods aggregate more than 183 days within 12 months period commences or ends. Now this is for the main 3 paragraphs for the permanent establishment, but we have the 4th paragraph. This is a 4th in here. The 4th paragraph, it is for the negative permanent establishment. I'm not coming to that. But in the 5th paragraph, it's discuss about the dependent agent and independent agent. Even the dependent agent, it created the permanent establishment. Now come to this. Okay. Now come to this one. In here, tell me, in this Poland company, did they have a permanent establishment as a fixed place of business in Sri Lanka? No. They are doing their activities in the hospital, which they have to accommodate and do their activities. And do they have these anything? No. The hospital is not the place of management. Then, no. And again in the 3rd one, the permanent establishment, in that, are they engaged in the building site, construction, assembly, drilling rig? Nothing. Then it is not applicable. And again, when it comes to B, what they are doing? They are providing a service. The developing of the information technology system on behalf of the hospital. Then they are providing, as their principal business activity, they are providing a service. Then in that service, we need to look at the 183 days within commences or ends within 12 months period. These employees, they are furnishing a service. Then it is the employees or other personnel. Then activities in this nature, they should be stay in aggregate more than 183 days within 12 months period. Now we need to look at, for this, I need to come for the question quickly. In the question, this it has given, which is the period what they have stay in Sri Lanka, 15th August to 20th February 2025. Then 15th August to 31st August. it's a 16 days. Then September, October, November, December, January, February. Then it's a September. In here, the 16 days, September 30 days, October 31, November 30 days, December 31st is the last, and January 31st, and February 20 days. Then it's altogether 189 days they are in Sri Lanka. Now, what is the commencers or ending period? If they came into Sri Lanka on 15th August 2024, and the 12 months ending on what's the date? 14th August 2025. Within this period, then they are in Sri Lanka for 189 days. Now under the Sri Lanka-Poland Double Taxation Treaty, under Article 5, Paragraph 3, they have created a service PE. Employees came into Sri Lanka, and for a particular period they have visited and they have done the activities and they left. Okay, then this is the deemed PE it has created. Then therefore, if there is a permanent establishment, what's the next step, Lamai? You have to look at the Article 7. What is the Article 7? The business profit article. What it has given in the business profit article, it's very clearly given if if there is a permanent establishment of a non-resident person, then it has a separate enterprise. We have to allocate income, we have to allocate expenses and pay the tax. In that, you have to apply the domestic law provisions in other than the provisions which mentioned in the double taxation treaty. Then that's what we are going to do. Now I really need to come for the Article 7 business profit article in Sri Lanka and Poland double taxation treaty. In here, the first paragraph, the profit of an enterprise of the contracting estate shall be taxable only in that estate unless the enterprise carries on business in the other estate through the permanent establishment. Now our case, the Poland, this company, it created a permanent establishment in Sri Lanka. If the enterprise carries on a business as aforesaid, the profits of the enterprise may be taxed in that other state, but only so much them is attributable to the permanent establishment. Then always the permanent establishment as a distinct, separate enterprise, you have to do the tax computation. And in here, subject to provisions of the paragraph 3, where an enterprise of the contracting estate carrying on a business in other contracting estate through a permanent establishment situated therein, there shall in each contracting estate be attributed to the permanent establishment the profit which might be expected to make if it were a distinct and separate enterprise engage in the same or similar activity under the same or similar conditions, and which is the dealing wholly independent with the enterprise or which is the permanent establishment. As the separate enterprise, you have to do the business profit calculations, and in determining profits of the permanent establishment, there shall be allowed as deduction expenses which are incurred for the purpose of the permanent establishment, including executive and general administration expenses so incurred, whether in a state in which permanent establishment situated elsewhere. Now, but these are all subject to the domestic law provisions. Okay. Now, as far as the all things, the reading of everything is very difficult. Even the head office expenses which actually incurred and what should not be incurred, it's given. But in our question, it's very clearly given. It's an apportionment. It's a allocated, not actually incurred. We don't have details. Okay. Then now everything in the question it has read. Now I need to come for the first part quickly, which is you have to advise whether MTGS is liable to pay tax in Sri Lanka. Yes, it is liable. Okay. Now come to the detailed answer, which is here. You may receive the relevant answers for paper, but for discussion, the simple answers it has taken. Then the application of the section 69(4), which I have explained. as per section 69(4), which is determining of the residential status of the company, as per the Act, if a company incorporated or formed under laws of Sri Lanka, or it registered or a principal office situated in Sri Lanka, or at any time during their management or control it's in Sri Lanka, then it is resident company for the purpose of income tax. Next, as per the information provided, MTGS, the company incorporated in Poland and thereby non-resident company for taxation in Sri Lanka. It's a non-resident company for the taxation in Sri Lanka. Secondly, accordingly, as per section 4, assessable income, the assessable income of a non-resident person is equal to the person's income from employment, business, investment or other source. Then this is for the application of the section 4, which is arising or derived from Sri Lanka. Then next one, therefore, as per section 73, the sources of income accordingly for non-resident person will be subject to tax. Lamai, that's why in the section 73, subsection 1M, in Roman 2, the permanent establishment, the business profit will be taxable part, it's included. And in domestic law, the Sri Lankan permanent establishment definition, it has given in section 195. Then here, however, to tax a business income of a non-resident company, there should be a permanent establishment. These are basic points. Then, in Article 7 of the DTA provided that profit of an enterprise of one contracting estate will only be taxed in other contracting estate if there is a permanent establishment, and through that if they are conducting a business. And therefore, the PE exposure need to be analyzed as per the Article 5 of the DTA based on the given information. Okay? Then based on the given information, MTGS does not have a fixed place of business by covering Article 5 subparagraph 1 and 2. No activity PE under, which is the construction site, drilling rig, nothing. PE under Article 5(3)(a). And no dependent agent created as per Article 5, subparagraph 5. The dependent agent, being a dependent agent, the dependent agent should have the capacity to conclude the contracts. And dependent agent, now without dependent agent, that non-resident person's operations are null and void. Then it's a dependent agent shall provide the activities which wholly or devotedly to the operation successful or effectiveness of the operation of the non-resident person. Such kind of the story it is not here. And now come to this. This is the analysis. If it is taken, this is the analysis of the, I will take like this. Then this is the analysis of the permanent establishment in the double taxation treaty. Okay, PE analysis. PE analysis. And next, the Article 5, in the Article 5 subparagraph B of the DTA, the furnishing of services. I'm not going to read this because I have read it already. And based on the information provided, employees of MTGS have been in Sri Lanka from 15 August 2024 to 20th February 2025. As such, the employees of the MTGS physically present in Sri Lanka aggregate more than 183 days within 12 months period commences on 15th August 2024 and ends on 14th August 2025. Accordingly, MTGS will be considered to have a permanent establishment in Sri Lanka and will be liable to pay tax in Sri Lanka. This is for the 5 marks. Then this all the details it has given, but for the it's a 9 minutes you have to utilize. Then your speed of writing, sometimes this entire answer you may not write, but particularly which is the main sections of the Inland Revenue Act you have to quote and you have to write carefully, and the provisions of the Double Taxation Treaty, which is the PE article, as requested by the requirement of the question you have to do. This is for the 5 marks. And for next, which is for the calculation, it's pretty straightforward. Then I'm coming to calculation using this information. Since I have read all these things, now I'm not going to read these things. Then there is a permanent establishment. Therefore, you have to compute what? You have to compute the assessable income from business. Maybe if there is investment also you have to compute, but in our case only business income. And again, you have to, from the taxable income from business, you have to go for the taxable income and you have to apply the tax rates and the remittent tax, all these things you have to do. Now come to the question, the part of the answer in here, which is I think it's clearly visible. If not, let me little bit enlarge of this answer. Then this is Meditech Global Solutions computation of the now. For start to compute the taxable income or assessable income from business, the question it has given income and expenses. Then we need to first compute if there are no gaps between the profit before tax or assessable income, then no issue. But first thing we have to have a figure of the profit before tax. Then that's the first thing which we are going to do, which is the income in the HIS system setup and customization, which it has given in the paper, which is the US dollar 450,000. It's a lump sum. It's at the point of their stopping it or starting, whatever the hospital shall pay this. Then that is my income. And second one, income for the first year, and on-site training, which is the rupees 60,000. And very clearly, annual license and maintenance, as per the details provided, this will be applicable after the completion of HIS, which is the Hospital Information System, which will be due from April 2026. Hence, not the income for the financial year ended 31st March 2025. We are computing profit before tax. Then this is not my income. Then this is my total income in US dollars. Okay. And this is my total income in LKR. What is the rate given? Is 304. Then this is the conversion. And after that, which is the expenses, staff salary, it's a allowable deduction. And very clearly in the question given, if something, it should be included to the particular 8 employees' employment income, it shall be included according to the provisions of the DTA. Then it shall be included and it is given. Then you don't have to think about this is the part of the employment income of that individual, relevant tax deducted. Then staff salary is given, cost of airfare, local traveling expenses for hospital visit totally incurred for the providing of this service project, staff accommodation and living allowance, the executive and general administrative expenses, then it can be deducted according to DTA, but again, in the domestic law, we need to apply the relevant provisions. Then head office expenses, when computing profit before tax, it can be deducted, no harm. And the server hosting cost in Poland, the apportion to Sri Lanka operations. Now, this is the total expenditure. This is the total expenditure and this is my profit before tax. The total income in LKR minus total expenditure, which is the 92,590,000. Up to this, I think it's clear. Then come to the computation of the business income. Then here we have profit before tax. Now from the profit before tax, you can see we have deducted the head office expenses. Then this head office expenses, we have to disallow first. Because under section 79, this is the provision. In section 79, this is as it is from the Inland Revenue Act, it has taken. Then no deduction shall be allowed for an amount incurred by a non-resident person as an expense of the business carried on by the non-resident person through a Sri Lankan permanent establishment. Nothing can be deducted, but what's the amount to be deducted? Then that represent head office expenses where the amount would exceed 10% of the person's assessable income. Then in some way they are arguing which is on assessable income එකෙන් 10%ක් exceed කරොත් මුකුත්ම දෙන්නේ නැහැ කියලා. No, that is not the provision. The up to the head office expenses. This is an arrangement which it has taken to minimize, reduce the profit shifting arrangements. Then if it is all the head office cost, if it is allocated to Sri Lanka, then Sri Lanka is the country which has the taxing rights to this permanent establishment to collect tax as the business income and tax business based on the business income, taxable income, and on that corporate tax and the remittance tax. Then if this head office expenses allocated, the profit figure it's will be coming down. Then after that, what's the residue for us? Then that's why this is kind of the planning, tax collecting provision it has implemented. Therefore, it's not the entire part, but it's a 10% it has provided. Now come to this, the 10% head office expense is a deduction from the business income. It's a deduction from the business income, but the thing is due to it's due to the conducting through the permanent establishment they are conducting a business, then therefore this particular head office expenses allocated, then it is the deduction from the business income, but it should need to take for the assessable income. Okay. Then in practically we are doing the reverse calculation, but I have not taken that for this one. Then here, then we have come to this profit before tax, which we have taken from here, and head office expenses I have to and in the general which is expenses included in general and administration expenses, then we have to disallow two things. What are those things? Donation. Now, how we are going to disallow these things where it has mentioned? In domestic law, somewhere it has mentioned, which is the donation under section 11, it has not incurred for the production of income, then it should be disallowed. And provisions, can you deduct? No, the same thing is applicable. Then 850,000 and which is a donation, both to it should be disallowed. Then this is the amount to be disallowed. Then business income before adjusting head office expenses. Then this is profit before tax plus actual amount of the head office expenses which already deducted and the disallowable expenses. This is the amount which before deducting the head office expenses, that application. What is the amount given? Less head office expenses under section 79. What's the maximum? It is a 10% of the assessable income. 10% of the assessable income. Okay. Then under that, this is from this 10% we have to take, and this is my assessable business income. This is my assessable business income. Now we have the amount which the first step for me to calculate tax. Okay. And this is for now the assessable income, this one. I can take this here. And from this, don't forget the donation amount. Is it 600,000 or it's a 650? Yeah, that is the place which it's 650, no? Okay. Then this is 650. Then this is my business income and assessable income from business and assessable income. Then this is my total assessable income. Then from that, again, the donation made to whom? There is a project it has done for the Ministry of Higher Education. I'm sorry, it is for the Ministry of Higher Education. Ministry of Higher Education. Then it is under 5th schedule in the section 52. This is totally donation made to the government. Then it can be deductible. Then here, this is my taxable income. On this taxable income, the corporate income tax 30% you have to apply, and the remittance tax. Then in the remittance tax lamai, which normally in patrically, let me explain these two. Then in patrically, we are remitting the profit after tax. In anyone in this forum, if you are patrically doing in non-resident and international taxation, in that, when it comes to this transfer of the profit to the non-resident, which is a head office, branch office and head office concept, then in that, through the permanent establishment, if we need to transfer the profit, we are transferring the profit. Then profit, it's a profit after tax. Then from we have the profit before tax. From that profit before tax, we have to remove the dividend income included in the PBT, because the dividend income is the final withholding payment, and we are after that amount we need to deduct what we have paid in Sri Lanka as a tax. That is the tax which we have computed and paid on behalf of the Sri Lankan operation. Then 30% tax we have to deduct. Then balance is the remainder. Then for that amount we are paying the remittance tax. But in here that's a patrical application. It has taken not only this patrical application in the accounting, in non-resident company taxation, then in the financial statement, that profit before tax, we have to profit after tax, we have to transfer to the changes in equity as it is normally we are transfer, and from that we need to take into the remit, and we have to provide the liability, and at the point of the making or remitting the profit, we have to make the payment to the based on the outward remittances. There are applications which is on the gross and net method, and all these things are there. Then you have to remit the profit earned in Sri Lanka. However, for exam Lamai, I have taken this one. For exam, in the examination perspective, their application is a taxable income. From the taxable income, the deduction of the 30% of the tax paid in Sri Lanka, then on that 14%. Then on that 14%, then it's according to the provisions of the Inland Revenue Act, it's defined as a remitted profit. Then remitted profit after paying taxes in Sri Lanka. Then in patrically we are applying this method. We are not taking the taxable income and from that deducting 30% and remitting the balance. No, we are taking what the non-resident person earned in Sri Lanka after paying tax, the whole amount. It's a remitting, and the applicable remittance tax on that we are paying. But for your exam perspective, then it is taken as a taxable income. In our question, this is a taxable income, which is 98,881,000, and from that current tax paid is the same 29,664,300. Then this is my taxable income after deducting current corporate income tax. Practically I have we are not doing this kind of the thing, but it's the remittance tax application on this, the 14%. Then both methods it has shown. Then for your exam application, please, it's going with this method which it has given as a permitted method. But when you are doing practically things, then this is the way it's application, because I need to clear this point. Then for your examination, please go through with the taxable income less current tax, what it has provided, what they have provided. Okay. Then this is on the remittance tax application and entire calculation. And again, I need to come for this one, which is the second or alternative answer, the application of the head office expenses. The same thing is there, but when it comes to the application of the head office expenses, the 10% of the assessable income, we are taking the 10% which after deducting. This is again practically what we are doing, and even in last time these two methods are there, the 10% application and this 110 application. Then both are there, and I thought it's explained to you again here. Then it's a head office expense applicable for the assessable income. then we have to take assessable income. ඒකට එන්න කලින් head office expenses අඩු වෙන්න ඕනේ. Then it's a reverse, which is the reverse back calculation we are doing. Then it's a take in 110 into 10. Then this is assessable income from business. And in that, the same applications, no change. The same application, and even in here, same application given. The both methods it has given last time. That's why this method has included. But it's as a permitted method for exam. I think it's good to go with the 10% and apply these things. But when you are doing things practically, then please go in line with that. Okay. Then this is on the computation, which is for the 6 marks. 6 marks. Then the next thing, which is last part of the discussion, which is 4 marks. In this, as a tax consultant, you have to advise whether senior accountant's opinion is correct or wrong. Now, for these 4 marks, you need to look at whether what is the opinion or what is the position, what is the statement given by the senior accountant. Now come to this one, which is the here. Further, Carwell Hospitals PLC, CHPL, intends to enter into a technical service agreement with Meditech Global Solutions with effective from 1st May 2025. This is a thing what they are going to do in future. With reference to if you are looking from the 31st March 2025, which from our year of assessment to going forward, then this is something they are going to do in future. Under the agreement, MTGS will provide online services, upgrades under technical support for the hospital information system, which was previously developed and deployed by MTGS. Now, system they have developed, through that developed system, then they are going to provide the technical services as and when needed. Then all services will be rendered remotely from Poland. That means no one from the Poland is going to visit Sri Lanka. Next one, no personnel from MTSL or MT, the company will be physically present in Sri Lanka. It should be MTGS. Then CHPL will make periodic payment to MTGS for these services. The senior accountant's view is that there is no income tax implication on such payments in Sri Lanka due to the absence of permanent establishment of MTGS in Sri Lanka. What's your opinion? Now you know these things. Then it's a 1 week for exam. Then what's your opinion with reference to this statement? Is it correct or is it wrong? What is the statement, the senior accountant's statement? Due to the everything provided remotely, then no permanent establishment has created as earlier they had. Therefore, for this, what's the service they are providing? What's the agreement? Technical service agreement. Now, this is the information technology, which is the hospital information system. It has developed. For that, this hospital, then does the hospital require the knowledge, help of the technical experts on this IT sector, on IT field? Yes. Then that's the reason the technical services agreement it has signed. Now the senior accountant's view, therefore, everything provided remotely, we have to pay a periodic payment as per the agreement. Then based on the information given, the agreement is for the technical services. Then it is not subject to income tax. What's the main reason it's not created a permanent establishment? Yes, Laman, I'm agree with the one part of it. This entire scenario for this, the second part, it has not created a permanent establishment. It's understood. But without it having the permanent establishment, is it avoiding the paying of the tax on this periodic payment? That's the issue. Then for that, you have to identify what is the source of payment to this non-resident person. Again, the same story, huh? Tam method in MTGS, a non-resident company. Then the payment made to non-resident company as a technical service fee in future based on the agreement. Then is it subject to income tax in Sri Lanka? For that, again, come to that. Then is it a source of payment in Sri Lanka from MTGS? Yes. What's the source of payment? Technical service fee. Then in Sri Lanka, which is in domestic law provision, as per Inland Revenue Act, what's the applicable rate? The 14% in technical service fee covering under section 85 2B of the Act. And in the first schedule, first schedule, subparagraph 10. Done. What is application in the double taxation treaty? Do we have the technical service fee article in double taxation treaty? Come to this, then of course we have. What is that? Article 12, which is royalties and fees for technical services. Now let me come to here. Who has the taxing right? I need to look at. Royalties or fees for technical services arising in the contracting estate and paid to a resident of other contracting estate may be taxed in that other state. However, such royalty or fees for technical services may also be taxed in the contracting estate where it arises, according to the law of that state. But in the beneficial owner of the royalties or fees for technical services is a resident in other contracting estate, the tax or charge shall not exceed 10% of the gross amount of the royalties or fees for technical services. Now what has happened? We have the double taxation treaty. The treaty maximum rate is 10% for both royalty and technical service fee. We are looking for technical service fee. And it has defined what is a technical service fee. Come to this definition of the technical service fee. The term fees for technical services as used in this article means the payment of any kind other than those mentioned in Article 15. Article 15 is for independent personal services. No, it's a dependent and independent, one of the articles. Then of the agreement as considered for managerial law, technical law, consultancy services, including the provision of services of technical law other personnel. Now this is clearly technical consultancy both. Then for the developer is providing ad hoc basis periodical technical service, which is a particular specified technical services as per the agreement, and this is covering under this article. Now we have double taxation treaty. The under section 75(2) we have to go with that, and the rate applicable under treaty 10. Domestic law 14. What's the rate you are going to apply? 14 or not exceeding 10%. It is not exceeding 10%. Why was the reason? Then if there is a double taxation treaty and if there is a disputes in between domestic law and double taxation treaty, what prevails? Domestic law or treaty? Treaty will prevail. Then accordingly, the applicable rate is a 10%. As such, the opinion of the senior accountant, is it correct or wrong? It's wrong. For all these analyses you have to do. All these analyses you have to do for 4 marks. Let me quickly come for this one, which is the for this 4 marks. Then evaluation of the accuracy of the senior accountant's position. Then under the double taxation agreement, I'm going a little bit faster because explain everything. Under the double taxation agreement between Sri Lanka and Poland, Article 12 specifically governs the taxation of royalties and fees for technical services. Paragraph 1 of the Article 12 provides that fees for technical services, FTS, arising in Sri Lanka and paid to resident of Poland may be taxed in Poland. However, paragraph 2 further, clarifies that such payments may also be taxed in Sri Lanka, the taxing rights given to source country, subject to a maximum withholding tax at the rate of 10%, provided the beneficial owner of the income is resident of Poland. Of course, it has given resident of Poland. Paragraph 3b define fees for technical services broadly to include payment made as consideration for managerial, technical or consultancy services, including provisions of the services of technical and other personnel. This definition clearly covers remote services such as technical upgrades, what they are doing as per the agreement, support and configuration performed or in online even in the absence of any physical presence in Sri Lanka. Then the absence of the physical presence in Sri Lanka is not a matter for this. And accordingly, the absence of the permanent establishment of MTGS in Sri Lanka does not particular Sri Lankans' right to tax this payment. The taxing right is with us. Even if there is not a permanent establishment, it's not a precaution for us to not to collect, for our revenue authorities not to collect tax on that. There are separate articles we need to look at. These, the relevancy of the PE is limited to application only for the Article 7, which is the business profit of the DTA. However, since the payment to MGSL fall consequently within the scope of the Article 12, which is the fees for technical services, the provisions of the Article 7 do not apply. Therefore, Sri Lanka retains the right to tax these fees at the DTA prescribed rate of the 10%. Okay? Then, under the domestic law, specifically Section 85 of the Inland Revenue Act, the applicable rate is the 14%. However, where DTA is applicable, then the rate is the 10%. Accordingly, the view of the senior accountant is incorrect. Now, for 4 marks, you have to analyze these things. This is a very lengthy, which is explanation. But in the exam, for you, you should analyze the, if this kind of the maybe for dividend, technical service fee, for whatever, interest, dependent person, independent person, anything if it has given. If there is a treaty, you have to analyze the treaty and you have to look at what's the domestic law and you have to take your conclusion. Okay? Now, this is for the, in the paper, which is the entire 15 marks, the non-resident and international taxation taking into consideration. Okay. Now, before moving to part 2, let me quickly come for the questions asked. Then, what is the first question? I'll come. Yeah. There is a small thing in a mismatch in here. And madam, can we mention what is the head office in this question? The head office, there is a, which is a, now they are conducting a Sri Lankan operation. Then it is limited to Sri Lanka. Then the head office is a Poland company who is supervising these 8 employees. Then they are conducting their servers and they are having activities to maybe monitor. Now all these costs, it has not separately embedded. Then therefore, it is not like in the permanent establishment. Always if there is a deemed permanent establishment, then in that we have to very clearly look at the Sri Lankan operation versus what is the company in Poland. Then this is the expenses relevant to the Sri Lankan operation. then under that situation, the Poland company acting on behalf of the Sri Lankan operations. Then that's why it has taken. And yeah, it's a 3B, correct. And what is the calculating assessable income directly without yes, you can do. ඔයගලන්ට පැහැදිලි කරන්න ඕනේ හින්දා step by step ආවේ. Then if you are very in a comfort zone, then take the income, take the expenses වලින් provisions of the which is the general, which is administrative expenses provision, and again donation ඒවා ගන්න එපා. But you have to do the head office expense adjustment and do. Then if you are so comfortable, please do. Well, I have taken step by step for the clarity of you all, but if you are in a comfort zone, please do. No issue. And next one, which is the if there is actual head office expense is about 10%, and let me take this. Actual head office expense is about 10%, and they have documents. Maximum limit is still no. For the actual head office expenses, Lama, you have to go with the double taxation treaty. If I have taken from the treaty itself, which is Sri Lanka and Poland, since this question is asked, let me come to this. In the Article 7 of the treaty, it has very clearly given was the treatment for the actual head office expenses. Sorry, this is immovable property article. This is a business profit. I think in somewhere it's some double taxation treaties. It has given in determining profit of the permanent executor insofar as the customary state determining profit attributable to permanent meeting. No, in here it has not mentioned apportionment. If there are, then it is we need to consider. And yeah, in this one, in Article 7, no, in this it has not clearly given, but in the most of the double taxation treaties, if you have taken the Sri Lanka and Singapore and even Sri Lanka and India, then no, this has not mentioned, sorry. Then in the double taxation treaties, specifically it has given, in double taxation treaties, specifically it has given if the actual head office expenditure incurred, but in that actual head office expenditure, if there is a royalty, if there is a which is that managerial or technical service fee, like a profit shifting arrangement, if it is there, we cannot deduct. It's very clearly given. Other than these things, if it is actually incurred, then according to the double taxation treaty provision, we have to take, but it should be actual. It should be actual, just not mere profit shifting or apportionment. Okay. Then even this one is not there. And then I have stopped here. It's done. And yes, thank you. Donation 650,000. I made a mistake and it's corrected. Only WHT has to pay it in Sri Lanka. Yeah. Thank you for the answers, which is on a technical service fee. Agency PE given statement is wrong. What is the given statement of the Chaman? Can you tell me in agency PE what is the given statement is wrong? What's meaning of that? This is considered as a royalty payment. Okay. It's subject to royalty at 14%. Then subject to royalty at 14%. Now come to the definition of the royalty. In the royalty, then in the definition, what it has given in here, 12, 12, 12. Then payment in any kind received as a consideration of the use of or right to use any copyrights, patent, trademark, design or model pen, the secret formula or process, or for the use of the right or use of the right to use any industrial or commercial or scientific equipment or information concerning industrial, commercial or scientific experience. Then how this can be royalty? Is this a right to use any copyrights? What's the copyright we are using? We don't have the copyrights. All the servers and everything is monitored by the Poland company. Then is there a patent we have to pay? No. Is there any trademark? No. It's applicable when then it's covered in under the article of the royalty and fees for technical services. Now, they are taking the technical service agreement. Then, accordingly, it is, according to my knowledge, is not covered under royalty. Then, which is the next question? I'm sorry. Which is the next question? Subject royalty, it has explained, and for the, I think the answers you have given, can we please explain why we apply domestic law for deductible expenses? It is not having a provision, it is not having provisions in the DTA for same, because it is the, now we have to pay. We have to pay the 30% and the, mainly for the 30%, the taxable income application as per the domestic law provisions. Then in the each and every double taxation treaty, it has given how to compute the business profit. Then from the business profit too, we have to come with the domestic law provision for us to apply the taxable, the rate for the, we need to come for the application of the taxable income for us to apply the corporate income tax rate. Then that's the reason we cannot restrict it, we cannot totally deny to the double taxation treaty provision, because in Sri Lanka, then we have to pay 30% of the tax to apply the, or to compute the taxable income. We have a mechanism. Then you may have the same question, why that head office expense, ඇයි මේක කියලා ගත්තොත් ඇයි අපි remittance tax කරන්නේ? Then I have to make it a tax then it is, which is we are in the domestic law provisions, we have to come for the business income, because the method of calculation, it is not given in the Article 7. Article 7, it has given the business profit, how we are going to compute. Okay. Then expenses, air ticket traveling, if we make the assumption, if out of production of income, yes, but in the paper, you have to read the question paper, it has given any benefit which is applicable to the employees, any benefit which is applicable to the employees, then it is subject to relevant taxes according to the domestic, not domestic law, double taxation treaty provision. Then if it is so, then going with that assumption, it's a maybe too tardy one then, but okay, as much as the logical assumptions are there, you can go. And can we disregard to, yes, our ඕගොල්ලන්ට කලින් කියපු විදිහට, now I have done this step-by-step computation by taking the profit before tax. එහෙම ඕන නැත්තම් quickly come for the assessable business income and do that. And I really need all of you to go to the latest past paper questions in question 1, the December 2024 question 1, one of the really good question for non-resident and international taxation. June 2024 question, at least these 2 papers are mine. You should go through these questions. The past papers are essence for you to pass the examination. Then, therefore, please, before now 1 week is there, you have to do the past papers and after doing past papers, then there are suggested solutions. Please go through the solutions, and which is if you are the coaching with the lecturers, then whatever the things, if you are not familiarized, then you have to sort it out. Then all these things you have to do. But my main advice, you have to do the questions in the past papers, especially in December 2024, which is June 2024. If not, but again, when it comes to which is on at least December 2023, at least at least two questions you have to do, lamai. How many minutes? දැන් අපි මේක දැන් නම් ළමයි මං හිතන්නේ අපි පාන්දර 1 2 වෙනකම් වගේ මේක කරන්න පුළුවන්. Then which is for this question is a 15 minutes. Sorry, 15 marks. Then if 15 marks, then 1.8 minutes, 27 minutes. In this one, it cannot do with the 27 minutes because I have to explain the things. Then it's a 27. ලකුණු 15යි මිනිත්තු 27යි. 15 minutes, 27 minutes. 15 marks, 27 minutes. Then next one, beg your pardon on the confusion. Made it as agency P, it is clear now. Okay. Then Lamai, this dependent agent P, it has tested. No? That's why I really need for you to go for the past papers. Then you have to do the past papers somehow before your exam. Again, this. I think it's very, very arrogantly said. It's a total capital. Then if actual head office expenses below the 10% of the assessable income, no. Then the comparison you have to do. Then what you have to do. Then it is, now I will take the commonly without confusing y'all. I will give a common answer for this one. Now think that your head office expense actual amount, which is it's given actual or allocated whatever, then it has given as rupees 20. Okay, then your the assessable income, from the assessable income 10% gattahama, then it will come as the, now we need to go with the, now maximum it's a 10% given, no? Then in the I will not take as the actual, then it's a one of the whatever the head office expense actual incurred is rupees 20. And your question, if it is below the 10% of the assessable income, then you can deduct it. Then we are going for a maximum 10%. If it is below 10%, then we can deduct it. Gihila assessable income making, you cannot take the 10% and deduct because then actual amount is below 10%, the actual amount can be deducted. Then next one, I think I cannot go further questions in this paper. Then can you please explain the treatment of head office expenses? Laksha, now after this it has done it. Then the head office expense is the two methods it has taken. It's normally 10% from the assessable income, but it is since it is from the 10% from the assessable income, you can go for the backward calculation also. But I prefer it's go for the 10% for your exam. Then even in the last time, in as the permitted methods, the all two methods they have given. Then for the amount which it's charged to the income statement, then it should be disallowed and you have to take the 10% and it is your deducted amount. Then after it's a deduction from your business income. Then after that, you have to do the rest of the parts. Okay? Then can you please explain? Yes, sure. That's what I really need. Let's move to the next question. මටත් ඒකම තමයි ඕනේ. Then ඉතින් ළමයි එකට යන්න දෙන්නේ නැත්තේ ඔයගොල්ලෝම තමයි. Then we will move. ළමයි now for non-resident and international taxation just enough. මේක නිකන් ජීවිතේ at the first time in your life you are learning this part. Then for the maximum explanations given, all the alternative answers given, and how it can be done, everything given, question explained, analyzed, and approach, everything done. Now let me conclude this question 1 part A. Okay. Now come to part B. And now I'm quickly doing these things. Then, which is in here for the 7 marks, what you have to do in 7 marks, give me 1 minute. Okay, for 7 marks, what you have to do, assess the income tax liability of Miss Gayani for the year of assessment 24-25. Then assess the living expense of Miss Gayani for the year of assessment 24-25. Very easy question. Really easy. It's for the 10 marks. Then 10 marks for both of this maximum you can utilize 18 minutes. 18 minutes you can utilize. Now let me quickly come for the question. While doing and reading, first I will take the 5 minutes and reading the question and I am moving to the answer. Then the same ground rules applicable. You can ask the questions after I have completed the discussion, and don't repeat the same question. Please ask whatever necessary. I will explain everything. Then come to this, which is the Miss Gaini Gunasekara was the Chief Internal Auditor of Best Life Private Limited and retired from her employment on 31st January 2025. Now, what is the year of assessment? You have to do her tax computation. It's the year of assessment 24-25. What has happened within this year of assessment? Now she has retired. Now you have to take these things into your mind. After servicing the position for a period of 30 years, she received the following benefit at the time of, she received the following benefits at the time of retirement. What are the benefits? Received from employees trust fund. Now your knowledge and application with reference to individual taxation. Where individual taxation has included, it is in your taxation and business decision making 10% of the syllabus area. Then in that, anything within that can be tested. Now in your actual exam paper, as always, it is the question 1 part 2 or a Roman 2 or a part B of the question 1 is always for the individual decision making perspectives they are looking. Then therefore you cannot avoid that part. The individual taxation knowledge you should have. And when it comes to this question, the first part it has given terminal benefits from the employment. Then this is received from the Employees Trust Fund. Total contribution by Best Life Private Limited, 7,560,000. Interest income or investment income, it's not the investment income from our fixed deposit savings investment. This is from the ETF contribution. What is in that? What you have received. Then when at the time of retiring, all this information are there in the ETF, EPF, what's the interest, what's the period, everything is there in that document which is issued by the Labor Department or Employees Trust Fund Board. Then here, up to 31st March 1987, then after 1st April 1987, it's a 2.8 million. Now let me come to this. This terminal benefit ETF contribution will be subject to the tax in which rate? A reduced tax rates. Where are the reduced tax rates given? In the first schedule with reference to the individual first schedule subparagraph 1. It has given. And when it comes to this, the interest income earned through the investments in employees trust fund, the time value of money or the premium I'm getting more than my investment, then this is very clearly up to 31st March 1987, it is liable for income tax. But after 1st April 1987, it is exempted. That's why these components were provided. And B, received from employees provident fund 32 million. What is the application of income tax on this? This is exempted. Exempted from the employment income as per third schedule. And retiring gratuity, this will be taxed but at a reduced tax rate like ETF. This is exempted. And these are A, B, C we have discussed. Then come to D. The amount of 2,527,200 was deducted as tax by the employer on terminal benefits. To employer to apply terminal benefit on this tax, they have to apply we have the APIT tables. In APIT tables for the lump sum, the retirement payments, you have to apply table number 3. Then accordingly, the applicable rate the employer has applied and it is given. Then tax deducted on that. But for individual tax, the application is different. The APIT table 3 application is different. That's why if you are in, let me 1 minute and take 1 minute and elaborate this one. That's why if you are getting a terminal benefits, then you have to file the return. And after that, we have to take the tax clearance on this tax deduction. And if there is a refund, it can be obtained to the taxpayer, or else the employer now trend is employees retaining this money, and we have to obtain the direction from the Department of Inland Revenue on the what is a tax amount which it should be paid to the Department of Inland Revenue, then based on that making the payment. Okay. Then E, however, after her retirement, she has joined to Farm Ocean Hotels Private Limited as a part-time employee for the position of Consultant Internal Audit Division. The agreement including the terms and conditions under employment. She is a part-time employee, but the agreement, it's as the employment agreement. She has the recruited as the employee of this particular hotel. Was signed prior to the commencement date of 1st March 2025. The new employment, what is the commencement date? 1st March 2025. Then we are doing the tax computation for 24-25. How many months for that? It's a 1 month, the new salary. According to the basic salary per month, it's a 200,000 and APIT deducted on this 10.5 million per month. Sorry, 10,500 per month. Then, in addition to the above, Gyne has following income: gross interest income from savings, her investment income, gross interest income from fixed deposits, gross interest income from foreign currency, this is exempted. Then now for this, already from the bank, the 5% WHT deducted, and dividend income received during the year 4.8 million, and as per the dividend warrant, out of that rupees 600,000 has been distributed out of dividend income received. Such companies, then dividend income, we have to take dividend distributed out of profit and dividend distributed out of dividend income. Then dividend distributed out of dividend income, it is exempted, and dividend distributed out of profit, it is final withholding payment. Okay. Then gain on disposal of listed shares, it is exempted. It's under investment income. And Miss Gyne disposal land, which was purchased by her on 10 December 2019. It has purchased after 30th September 2017. Then the cost of the land as per the deed of transfer, rupees 6.2 million. Then this is the acquisition cost, and she sold it at a consideration of rupees 9.5 million on 27 December 2024 within our year of assessment. The assessed value of the property as at the date of disposal, 9,940,000. Why we need assessed value? You have to know the application of the section 38, the consideration of the investment asset. Then advertising expenses incurred on disposal, 25,000. What is these advertising expenses? The incidental expenses on disposal. She has paid capital gain tax. These are the points you're missing at the examination. She has paid capital gain tax correctly on due date. Now don't forget this. By the way, what's the due date of the capital gain tax? Is there any due date given for the payment of the capital gain tax? Yes, it is within 30 days. Within 30 days from the end of the calendar month in which the transaction happened, you have to make the payment. Please remember the date of the transaction is this. The date of the transaction is this. Then from the date of the transaction, then end of the in the month which the transaction is applicable, then within 30 days of in that end of the calendar month, you have to make the payment. Okay. Then her additional house situated in Gampaha. Her additional house situated in Gampaha provided for rent from 1st June 2024. Not for the entire year. It's June, July, August, September, October, November, December, January, February, March. For the 10 months. For 10 months, it has provided for rent for a family at a monthly rent of rupees 80,000. Then is this make a business purpose name? This is for residential accommodation purpose. That's why it's for a family. Other than rates paid amounting to rupees 65,000 for the year, there were no any other related expenses. Then this is rent income for our year of assessment. It is only applicable for the 10 months. And please remember the rates is paid for the entire year. Then entire year, the property was not given for the rent. For the rent, we can deduct expenses under section 11, subsection 1. If the expenditure incurred for the production of income of the investment. Now in our case, from this 65,000, for entire 65,000, it's not incurred for the generation of the rent income because it's occupied period only for the 10 months. It's not for the entire 12 months. Then you have to apportion it for the 10 months period. And next one, which is the Miss Gaini made the following payments during the year of assessment. Donation amounting to rupees 100,000 to Elders Home and original supporting documents are available. It's the Elders Home under the 5th schedule, the institutionalized approved charity under institutionalized care for sick or needy. The home maintained for look after needy, sick or needy people, which is elders. Then this is eligible, but the limit you have to look at. Then tax paid for 4-quarter installments is a 400,000. Installed 10 kV kilowatts rooftop solar electricity system and connected to national grid. The condition satisfied in her house on 25th February 2024. Then she invested invested sum of rupees 1.5 million in cash for the purpose in this installation. For the purpose of this installation. For this purpose, she used the money received from her retirement. This should be 5. Then, now what has happened? The solar relief application. What is the maximum amount of solar relief? It is 600,000. It's a 600,000. Who is the person eligible for this? Resident individual. On what? Resident individual fix the solar to the premises and it's connected to what? Connected to the national grid. Connected to the national grid. Then she has retired on the 31st January. Then using that money, she has fixed this. Then the withholding agents have correctly deducted the withholding tax relevant to the year of assessment. Then that's why on interest, it was there. For exempted interest, it is not there. Then this one, the following are the details of her cash and bank balances. This is to computation of the living expenses through the receipt and payment account. Then this is the opening balance of the cash and cash equivalents, and the deposits, and this is the closing balance. Okay, then we need to look at what's the increase of the receipts and what her assets in cash and cash equivalents at the beginning, at the end, and what she has earned or what she has received, and for what she has paid. She can put fixed deposit, she can put which is the on the solar, and everything she can do, but she has some amount to live. ජීවත් වෙන්න සල්ලි තියෙන්න ඕනේ. කන්න බොන්න අඳින්න ඕනම දෙයකට සල්ලි තියෙන්න ඕනේ. ඒව නැතු ඔක්කොම කළාට පස්සේ living figure එක minus වෙනවා නම්, if my living expense is minus, I have what? I have undisclosed income. I have undisclosed income. Mama invest karala thumping amounts, but I don't have money to eat. Then I don't have money to pump fuel to my car. Then that kind of situation cannot be happen. Please note that in individual tax, in each and every individual tax computation we are doing practically, we should prepare this receipt and payment account. It's not provided to the Department of Inland Revenue, no, but at the finalization, each and every tax computation we are preparing this receipt and payment account, and we need to look at what's the position of the living. If the living is not enough or it's a minus, we are not going to finalize the tax computation until we are getting the correct or relevant information to finalization. Then there's a very much practical application. Even you can go for the net wealth method, but in practical we are now not much using the net wealth because we are looking for opening wealth to closing wealth, how it has improved and what is the amount which as the remainder for you to live. Okay, then these are the information. Now I'm quickly come to the answer. We have to before that I need to come for the requirement. Assess what you have to assess. Income tax liability. Make a කියලා නැහැ. In this question it has not given for you to assess the balance tax payable. No. What's the difference between income tax liability to balance tax payable? The tax credits. Then it has asked for you to look at the income tax liability. ගිහිලා tax credit තියෙන ඔක්කොම apply කරන්න යන්න එපා. Please look at your requirement. According to the requirement, please do the things. Okay? Now come to the answer. I'm quickly taking answer. This is not a difficult question. Okay, then here, okay, then which is this one? I think it's peaceful is visible. Now come to this. I'm not coming to facts again, Lamaya, since everything done. Then which is underemployment income, the schedule one. This is a method which I'm doing and which I really need to tell students who are doing strategic level exams. Then you should have to follow particular formats. Then especially for SL3, your answer should be very clearly visible. You cannot do in a part of this side and part of that side, and it's not a way for you. Then you should have a proper format for your paper. It's one of the expectation by the examiner is the clearly engaging with the comprehensive tax computations. Then it should be clearly visible. Because very clearly it's given in the act. The each sources of income should be computed separately. Then that's what we are doing. Therefore, please do these things separately. It's very important for you to obtain marks because your answer is very clear to the person who is looking at your answer. And being strategic level students, you should have the clarity in your answer booklet, in your answers. Okay? Then come to this, the benefits from the, now her primary employment is what she has newly joined, which is 1 month only. Then it is rupees 200,000. And terminal benefits, as it is from the question, which is the employees trust fund. Anyway, I had to move to the question. Employees trust fund. It has, while doing this, I need to go for the cash account also. Then contribution from the employees trust fund, 7,570,000. This is that. Then this is employment income. This is terminal benefit contribution. And here receipt and payment. Then I will take one by one. Employment income, it's my receipt. Mage labima. Then it is, I have taken the T account. And it's a T account rather, may pat the receipts, may pat the payments. Then this is, then this is the receipt side. And this is the payment side. Okay, this is the receipt and this is the payment side. Then she has received 200,000, and again she has received the total terminal benefit it has taken. I'll come to that. Then the ETF and in that ETF interest is there up to 31st March 1987. It is liable, but as given in the question, the benefit is 0. Then nothing to tax. And secondly, employees provident fund, the after 1st April 1987, it is exempted. This is as it is given in the Inland Revenue Act exemptions under 3rd schedule with reference to the employment income. And employees provident fund, it is exempted. And gratuity, it's liable at the reduced tax rates. These are the terminal benefits. These are the terminal benefits. Then here, all terminal benefits, the summation 7.5 plus and 2.8 million plus 32 million plus 13.5 million. The 55,860,000, these are the receipts during the year, what she has received. This is the answer. Now in the receipt side, the salary and the terminal benefits taken. Then the next, which is under, now everything with reference to employment income it has taken. Now what I have done, I have taken the employment income which is liable at the normal rates and liable at the reduced rates. Then total, it's a 21,260,000. It has divided into this 2 and taken the total. Understood? This is for my reference when I'm doing my tax computation. These 2 figures I need. That's why it has separately taken. If you are familiarized with the application of the reduced tax rate, you can apply. But for me, it's my approach. You are free to apply anything. Then again, when it comes to this, I'm going by one. And this tax amount paid on the terminal benefits by the employer, 2,527,200. This is the cash outflow. This is a cash outflow. Then, which is the income tax paid on terminal benefits, it's a payment side. It should be there. Next one, in the question, which is the salary. In that salary, there is a APIT deduction. APIT deduction, it's only per month, 10,500. It is my cash outflow, which is the 10,500 APIT deduction. Okay. And next, which is the interest income. Then gross interest income from savings and FD, and these 3 bullet points let me take. In our calculation, quickly I need to come for this investment income. Then you have to very clearly recognize exempted or final withholding venama and liable part venam and total separately. Interest income from savings, interest income from fixed deposits given, foreign currency, it's a 650. Then it's a rate is at $1 equal to 304, then it is there. Now all these three is my receipts. On the other hand, of this LKR savings account and LKR fixed deposit, I have what? Withholding tax. What are those? My cash outflows. Then I need to adjust this, which is here, the interest income in local, you can see the summation of this two. The summation of this two, it has taken, and from this two, this one plus this here, it's into 5%. This into 5%, this is the withholding tax application, 125,625. This is my deduction. Then WHT paid on interest. Not only that, I have the foreign interest income, which is 197,600. It is exempted from income tax. But is it my receipt or not? It is my receipt. Then I have to include it here. Foreign currency amount in the US dollar 650. Then here it's 197,600. Done. And next one, the all three interest and the WHT it has taken. And here, which is the dividend income. Dividend income received during the year. It's the one part is a final withholding. I have explained that. Then exempted dividend, dividend distributed out of dividend income. You have to very clearly recognize these things. If these are tested, you have to very clearly recognize. And liable dividend, which is 4.2 million. Altogether, 4.8 million. And I'm coming to my resident payment account. Dividend income which I have received is a 4.8 million. And the next, which is which I can visualize your questions when it's coming to this question. Then gains on disposal of listed shares, 314,500. It is exempted. It's a part of the, let me come to here. Gain from disposal of listed shares, even it's exempted. It is my receipt which I have received. And this one, which is gain from disposal of listed shares, it is exempted. It's not taxable. And next question, which is on the disposal of the land which held as investment asset. I'm coming to work in. It's a gain on disposal of land, which is gain is there. When computing gain, I need to come for this. With consideration in the question, it has given it's a selling price 9.5 million and the assessed value is 9,490,000. Then whichever is higher, I need to take out of this the assessed value or actual selling price. Then whichever is higher, I need to take where it has mentioned in the section 87 of the Inland Revenue Act with reference to the disposal of the investment assets. Then this is the amount, the highest one, and 30th September 2017 valuation not applicable at all. In the question, this land, it has purchased in 2019 if not mistaken. Yeah, 10 December 2019 it has purchased. Then 30th September 2017 valuations, it's not applicable for this question. Then this is the acquisition cost. It's given 6.2 million in the question. 6.2 million, and we have incidental expenses at the point of the disposal, 25,000. Then this is my total expenditure incurred, and I have ended up with a gain on disposal of land, which is subject to what's the rate? 10% of the capital gain tax. Why it's a 10%? This is applicable for individual. The individual, the capital gain tax rate is 10%. Then this is the gain. Here we go. The gain on disposal of land, 3,275,000. Now from these, now come to receipt and payment account. I have consideration on disposal of land. And I have the 25,000, the incidental expenses. Let me take that. The 25,000 as the advertising expenses. Advertising expenses on disposal of land. Disposal of land. Okay, then the advertising expenses you have to take here, and I will explain that if you ask the question, then these are the expenses incurred on this disposal, and this is the income it has received. And next one, which is the for this, she has paid the capital gain tax. Since I have the amount of the gain from this, the 10% I have to pay. It's 327,500. The capital gain tax paid, this is the amount, the 327,500. Why it is applicable for our year of assessment? Then what is the date of the transaction? It's the 2024 December. Then end of the calendar month in which the transaction happened, 31st December. From that 30 months, 30 days from that 30 days. 30 days it's counted to 30th January 2025. On that date, this taxpayer has to make the payment of the capital gain tax. Now already in our year of assessment up to the 1st April to 31st March, is it paid or not? It's paid. Then that's why it has taken. Then which is the next one? Here we go. And this is the everything with reference to this it has taken, and the rent expenses, rent income and relevant expenses on rent. Then here the rent expense, I'm quickly coming to this. The rent income, it's only for the 10 months, which explains it's only for the 10 months. And rates paid, expenses incurred for the production of income of investment. Then rate paid only for occupied period of 10 months. මේ income එක ගන්න අදාළ වියදම් තමයි අඩු කරන්න ඕනේ. Then not for the entire year. Then this is 65,000 divided by 12 into 10. Then assessable rent, it's a 745,833. And for this, here we go. This is my rent income, assessable rent income. In the cash account as rent income, I have received rupees the 800,000 interest income from local source we have taken, and we have paid the rate 65. The මෙතෙන්ට apportion කරගන්න එහෙම එපා. We are preparing the receipt and payment account. Then what we have already received and what we have paid. For the tax purpose, we are taking a different concept. In here for receipt and payment, we are looking for what are the cash inflows and outflows, which we have done. Then the next one, which is the other payments in the donation amount into rupees 100,000 in the cash account. The donation is my cash outflow. The 100,000 is there. And when it comes to the tax computation of this individual, Miss Kaini, then we have the donation, because this is the institutionalized care for sick or needy. Then for the individual, what's the maximum limit? The maximum limit is rupees 75,000 no actual donation. Then from that order, 1/3 of the assessable income, whichever is lower. Then lowest one is the 75,000, then it has taken. And then which is tax paid on quarterly installments. Let me take it here, I will come to that. Then on the installation of solar, the 1.5 million, it's a cash outflow. Then fixing of solar, 1.5 million, or it's a 1.8 million. It's 1.5 million. And for this solar, then she has the solar relief of, not here, in here, the solar relief of rupees 600,000. Solar relief of rupees 600,000. And next one, which is withholding tax, it has deducted. That's all on the entire computation. Now let me finalize the computation quickly. Then this is the investment income, everything taken. I think I have not missed anything. Then this is the total of my investment income, and this is the relevant workings on that. And this is my total employment income. In that I have divided the employment income liable at the normal rate and the reduced tax rates. Done. And this is my tax computation, which is in the for particular taxpayer for the year of assessment 24-25. Then employment income, it has given for this. I have very clearly then very clearly it has given the employment income from the which on terminal benefits as well as the in now her regular profits, and investment income it has taken. And the secondly, this is a total. Okay, it's not coming. Then this is a total assessable income. Okay, then this is total assessable income. For that, personal relief 1.2 million you have to deduct, and rent relief out of the rent, assessable rent which we have taken. The assessable rent is 745,833. Then from this, you need to take the 25%, then it's 186,458 taken, and here this is the total deductions as a relief. Then I have the qualifying payments. Okay, now Lamai, don't go and deduct this 1.2 million and 186,458. Anyway, for the solar we have taken actual. Then don't. These are the reliefs given. Then here, this is my taxable income. This is my taxable income. After considering assessable income, we have deduct the reliefs as relevant, and we have deduct the qualifying payments. Done. Then this is my total taxable income. Now come to application of the tax rates. Then the different tax rates you have to apply. I'm taking the first one out, the tax application on the gain from realization of an investment asset. The 10%. Now I will take one by one. This is my taxable income. From this taxable income, the gain from realization of investment asset, can you give the benefit of the tax-free allowance? No. It's very clear. Mama it's given in the act. The tax-free allowance benefit cannot be given. Then what I am doing without taking any other benefit as it is, the amount of gain cannot be reduced by any loss. Then it's normally the total capital gain we have to tax as it is. No relief, nothing, it will be applicable for that. Then this is my capital gain. Wait. This is my capital gain, which is 3,275,000. For this, then I need to deduct this one from here. And for this one, I have to apply the 10%. Taxable income the capital gain I have to remove because already I have taxed that. Now the tax on gain from realization of investment asset is a 327,500. Okay. Then this is the balance taxable income to tax. Now again, in this balance taxable income, I have terminal benefits which will be taxed at the lower rate. This is the terminal benefit. Then in the terminal benefit, we have to apply the tax rate separately. Then in this, which is the tax on terminal benefits, come to this. Since it's going with the reduced tax rates, let me ask this question. Since it's going with the reduced tax rates, in which benefits you are going to give this benefit of the tax-free allowance? benefit of the solar relief, benefit of the 25% of the repair allowance and the qualifying payment benefit. In which part you are giving that? Then is it you are giving for the which is on the lower rated benefits, or else you are giving for the higher rated benefits? So higher rated income is you have to give for the higher rated. Then that's why we have to divide this separately. Now how, as per the first schedule of the first schedule, para 1, subparagraph 3, on terminal benefits, how we are going to apply the tax rate? Then it is on first 10 million at the rate of the 0%. Then on next 10 million at the rate of the 6%. This separately you have to do. And on balance 12%, on balance part it's a 12%. Now I have the total terminal benefit, which is the amount is the 21,060,000. Now first 10 million I have to remove, and for next 10 million it will be applicable rate is a 6%. And what is the balance we have to go? The balance which we have to take, it is the 1,060,000. On this 1,060,000, then you have to apply the rate of the 12%. Then it's 127,200. This is a total tax liability which I have taken here. Tax on terminal benefits, which in the note 1. Done. And next, on balance taxable income, I have 1,396,875, which will be liable under normal tax rates. Which will be liable under normal tax rates. In that, on first 500,000 6%, on next 500,000 12%, and on balance 18%. Then this is on my capital gain, and this is on the terminal benefits, and this is on the balance taxable income entirely. 1,216,000 is my tax liability. Now when it comes to receipt and payment account, which everything we have taken, but other than two things, one is the opening cash balance and other one is the closing cash balance and the tax payments. Then here cash in hand opening, it's which we had, it's a 25,000, current account 420, and the savings and fixed account, which is the fixed deposits. Then these three, these are opening, which we had. And this is closing, which we have, it's given in the question as 30,000 in cash in hand. It's a current account 560, and the savings accounts and fixed deposit is a 60 million. Why it's 60 million? Because she has received a lot in this year. Then savings accounts and fixed deposits and current account and the cash in hand, for all these things, it's completed. Now the payment of quarterly installments. Then in payment of quarterly installment, then in the question, it has given what? Tax paid for four quarterly installments. Tax paid for 4 quarterly installment. What are the quarterly installment due dates, Lamai? There are 4 due dates for the 24-25. It's the first one is the 15th August 2024. And the second one is the 15th August, September, October, November 2024. The next one is the 15th February and the 15th May of next year of assessment. Then this paid 4 quarterly installment payment is assumed. I have assumed that for 1 quarter it has 100,000 paid. Then for the 4 quarters equally paid, then it's a 400,000. Accordingly, the hour period, its application is only 300,000. The 4th quarter installment payment, it has paid on 15th May. Then therefore, since it has paid in the 16th May, 15th May, then therefore it's not my cash outflow. It's not my cash outflow during the year of assessment. It's a assume and take and entire 400,000 you can take as assuming. Then fourth quarter payment will be due on 15th May 2025. Therefore, not a cash outflow for the year of assessment 24-25. If not, you can take the හිතන්න බැහැ නම් then you can write entirely the 4 quarterly installment payments considered as a cash outflow, and it's assumed that fourth quarter payment it has paid during the year of assessment 24-25. Okay, then this is the entire application of the cash account. Then this is included in your syllabus, which is under again individual taxation, under taxation and business decision making, and this is for the considering considerable adjustments of the individual taxation. Then this is the individual tax, but the requirement is only up to computation of the tax liability. Then with that entire 10% it has completed. Totally the first question it has done. Totally first question it has done. Then which is we need to move to the question 2. Before moving to question 2, any questions you all can ask. I think all of you had the questions on the non-resident and international taxation. Other than that, I'm so happy you don't have any questions. Now quickly come to the question 2. And this is this on financial services question. Then come to this, and for this one we have to use the on FS, the gazette notification. I think no question, I cannot see. There are question. There are question. I don't know why it has not taken. It's not notified to me. I'm sorry. Then Apoy, there are many questions. Ikmanta and Budu Ammo. There are many more questions. Within a month, Chaman, within a month, capital gain what now you're in fire. It's that provision has changed. That provision has changed. Now it's within 30 days from the end of the calendar month in which the transaction has happened. Then if Gaini has retired from 31st January 2025, why only new employment salary only taken for the consideration for primary employment benefit? Mani prashna therenne which is the if Gaini has retired on 31st January 2025 and she has joined the new company from 1st March 2025, as at 1st March 2025, in the same year of assessment, she has 2 primary employments. From one primary employment it has terminated and other primary employment it has started. Then according to the Gazette notification, the very clearly for 2 employees, up to the period that she has in the primary employment, she has to take on the T10 certificate. And because in the same year of assessment, the 2 employment, I think it has given it's taken, it's a 12-month salary. Where is the 12-month salary of her the previous employer paid? Why isn't that given in the question? No, it's in the question that we need to find out. No. It's not need to find out. Then she has retired and her terminal benefits were taken and the date of the retirement it has given. Then up to that period, the salary it has not mentioned. If it is not mentioned, then don't take it as the hypothetically. If it is given, please take. Okay. Then the next one. Sola is out of retirement. So 600K can be done. Anyway, it's for the solar investment for the president individuals. Then there is a relief of the 600,000. Madam, if the recipient is the payment account, then wait, what it has asked, this 15% thing, madam, can we please explain why pension relief of 10 million was not separately considered while arriving at the taxable income? Then we have considered it while arriving at taxable income, how we are deducting it for the total taxable income. Is it applicable for your entire taxable income, or as per the first schedule, the subparagraph 1, that para 3, is it only applicable for the terminal benefits? Then it's a for the taxable income on terminal benefits, then it's a rate is 0. Then we have to apply it separately. Then I mean why it was not deducted from assessable income. Daruo, assessable income එකෙන් අඩු කරන්නේ මොනවද? What's the gap between assessable income and taxable income is qualifying payments and relief. That 10 million, is it a relief? Is it a qualifying payment? No. Then can we finish the question 3 first? No. I'm going with the order. Then at the finally I will take the question 3. මේ paper එකේ තියෙන එකම question එක question 3 විතරක් නෙමෙයි. In the exam also you are doing same thing. Then there are many questions. Then you have to do entire questions in your paper. Then if it is so, you can pass. Therefore, Chanaka, wait. Then, yeah, not for you. Me also need a break. Then we will take a break. If they ask balance tax payable, we need to show APIT, dividend withholding tax. Dividend is a final withholding payment. It's not a tax credit. And installment as tax credit. APIT 10,500 and the 5% withholding tax, 10% capital gain tax paid, and quarterly installment payments. For the all 4 quarters you have to take. All 4 you need to take. And I think one student asked about the capital gain tax of the entity 10%. Entity not the 10%, it's 30%. And the next, EBIT, dividend gannipa, WHT on interest, and the which is 10% of the capital gain tax paid and the installment payments. What is the capital gain tax rate for the entity? 30%. Individual partnership and trust income tax computation are there directly in our SSCL syllabus content. Yes, it is. It is trust nahe, partnership nahe, but individual. Then Lamai, you should need to. No. Nothing. Then individual tax is there. In your taxation and business decision making, the individual taxation has included. In 2020 curriculum, up to December 2024 paper, in your past papers, individual taxation has tested. Then what is the material we can use to brush up this computation? Oh my God. Then the brush up this computation, if you are self-study, then the study text is there. The study text, everything updated according to my knowledge. And other than that, you can use the past papers. Past papers, if you are self-study, then since we are taking gross dividend to investment income, don't we need to 15% WHT deducted from the payment side receipt and the payment? Yeah, we can take the net dividend, then net dividend, and we need to take it. Then here the receipt and payment, it's 15%, which is the net amount we have taken. Good, thank you. It is 4.8 million in the dividend income, and the WHT paid on dividend income, which is WHT paid on dividend income, which is on distributed out of profit, not for the exempted part, distributed out of profit. Distributed out of profit, then it is the amount is 4.2 million. In 4.2 million, the 15%. Okay, 4.2 million in 15%, it is applicable. That's correct. Then it's only taken for the 4.2 million because other 600,000 is the part which is the exempted dividend. Then is the question. Then what's the question? 15% honey. It's Piumal, thank you very much for that. Then here, not received the admission yet. Please call tomorrow, and if there is any issue, then I think all of you did you confuse from here in exam date is 22nd? Then confuse further. Daru exam is on 22nd, which is on next Sunday, or I don't know. It's in the next week. Then solar relief reference, please, which is in the 5th schedule of the Inland Revenue Act. Inland Revenue Act, 5th schedule under the relief. Can we deduct both 25% rent relief and related expense for rent at the same time? Yes, why not? You have mixed this with the repair expenditure. Lamai, the 25% of the repair allowance and repair expenditure same time you cannot deduct. But related other expenses, repair novana tava viyadan taranna pulwana rent එක වෙනුවෙන්, then it can be deductible. I think no more questions on this. Now you will, okay, no more questions. Then now we all need a break. Lamai, what I can do, I will continue for question 2. It's one of the easy question. Then I will continue for the question 2. And then no, I will give maximum 5 minutes break. It's a 9:20, 9:25 ender. Log vendor, log velam in there. Then 9:25, I will come back. Okay, Ramya, I will start. If not, it'll take more time. Then I will start. Then you all can join peacefully. Then come to this one, which is the question 2, part A for the 15 marks. It is what you have to do. Assess the VAT and SSCL liability on financial services for the year ended 31st December 2024. Then it's given for the 31st December 2024. It is covering your testable year of assessment. But for the VAT on VAT on financial services, it has taken 31st December 2024. The reason is most of the, not most, it's all banks and financial institutions, their financial period. It's a 1st Jan to 31st December. Then what you have to do, you have to assess the VAT and SSCL liability on financial services. Then for the year ended 31st December 2024, then as per the provisions of the VAT Act, why it is for the year? Then what is the taxable period for VAT on financial services covered in under section which is from the section 25A of the VAT Act? Then it is a 1 year. It's a 1 year. Then that's why for all detail it has given. Now come to this one, which is the details of the question. I will come quickly. And for the VAT on financial services, then this is the gazette notification you have to apply. The everything you have to do it in accordance with the gazette notification. This is your open book referential material, which is the 2316/13. This is your open book referential material, which is the issued on this is a new gazette. In earlier we had another gazette. By cancelling that gazette, now we have this gazette notification. It's not new, it's from the 24th January 2023. Okay. Now everything we have to do in accordance with this gazette notification, because this has issued after the SSCL enactment. Then this is how we are going to, I think all of you all know about this. Then therefore I'm quickly taking the computation and the relevant information. Then come to the paper. In here, it's for the 15 marks. Then if it is for a 15 marks, then your time should be 27 minutes. 27 minutes you have to take. Then here, Zenith Capital Finance PLC, this the financial institution we are looking for, is a licensed finance company in Sri Lanka listed on Colombo Stock Exchange. The company offers a range of financial services including leasing, loans and deposits mobilization. You are provided with the following extracts of the financial statement for the year ended 31st December 2024. For VAT on financial services, we need all financial information. Then extracts of the income statement for the period ended 31st December 2024. Then interest income given with the supported with the note, interest expenses given, net interest income given, and fee and commission income, net trading income, other operating income, and total operating income. And impairment charges given, and I have put this one. Okay, the impairment charges given, and again the operating expenses, personal expenses, depreciation of property, plant and equipment, amortization of intangible assets, amortization of right of use assets, other operating expenses. Then all these things are given, and which is the operating profit before tax on financial services given, and VAT on financial services and SSCL and financial services, profit loss before income tax is given. Now this is the starting figure for our calculation. This is the starting figure. Something happened. This is the starting figure for our calculation. Okay. Then net profit before tax. Then when I'm using this thing, no, I'm not using this. Okay. Then profit loss before income tax is a 349 million. Then it's million or it's thousand. Then this is the amount you have to start. What we are going to do, we have to apply the format of the, now this is about on financial services question. Then in that, then we need to very clearly identify what are the income from financial services, and secondly, what are the income from non-financial services. That is the first thing you have to do. Why? You have to compute what? You have to compute the value addition attributable to the financial services. You have to compute value addition attributable to the financial services. Therefore, then if as a combine of that business activities, this organization, if it is doing financial as well as non-financial, then in that context, very clearly we need to know what is the total turnover as the financial statements, and from that, what is the non-financial, what's the financial. This is the first step which you have to do. If there is a combined business activities with the financial to non-financial, it is given in the for exam. If it is tested, make a test then in the like in normal what question can become, anything can be happen, then be prepared for anything. Then which is the second one, after that you need to very clearly take the figures to do this. What is this? The value addition computation. Then you have to take financial figures which given in the question for you to apply it to the gazette notification on the computation of the total value addition. That's second step. After that, it's nothing. Then you have to apply on the 18% and the 2.5% on the value addition attributable to the financial services without tax. For that figure, you have to apply the VAT and the SSCL. Now that entire process we are going to do. Now for that, I need to come for the balance part of the question. But what I am doing, I need to take this as starting the first one, which is the profit before income tax. I need to start from that. Then in the answer, which is here, in Varon Financial Services, this is the company, and for the year ended 31st December 2024, accounting profit before tax. This is the answer, which is accounting profit before tax is there. Now I'm going to do the first step quickly, which is the separation of financial and non-financial services income as per section 25F. Then for that, I need to come for the details of the income given in the question. Then in the interest income, loans and receivables, I clearly need this tool, but I don't know why it's not working now. Then loans and receivables, okay. Loans and receivables is a part of the financial services. Interest income from Sri Lanka government securities, yes, part of the financial services. Financial leases, but we need to look at the composition of the financial leases, and the hire purchase, it's a part of the financial services income. Then note number 2, fee and commission income, where the fee and commission income it's given. The fee and commission income it is here. Then for that there is a note given. SSCL, which is our company, earns fee and commission income from a diverse range of the financial services it provides to its customers. These fees includes credit-related fees and commission income. Now, fee and commission income is a totally financial service income. And the net trading income, it's given in the question. Then here, in dividend income from financial assets, dividend income is based on the provided information, it's a part of the financial service income. And the appreciation of the, it's not a depreciation, it's appreciation, then in the market value of financial assets recognized through profit and loss, then this is not a particular income for us because it is the fair value adjustment it has made. And the type of income which is under other operating income, which is the profit on disposal of property, plant and equipment. No, this is the profit part we are not taking. This is non-financial. Rent, it's a non-financial. Sundry income, anyway, it's a non-financial. Then based on that, the details, and after that, which is given, personal expenses, salary, other allowances, EPF and ETF, leave encashment, bonus, gratuity provision, staff welfare, cost of staff training program, amortization of staff loans, which is in the day one difference. Then when it comes to gazette notification, since I have gone for a personal cost, then come to this, which is the emoluments payable. The emoluments payable, what it has given in the Gazette, means gross remuneration payable to all the employees. Gross remuneration means the aggregate of both benefits in money and benefits not in money, cash and non-cash benefits both, payable to the employees, and it includes any payment, contribution, no, provision relating to terminal benefits, including the terminal benefits, which is charged to the income statement in arriving at the operating profit. Now this is on the personal cost. Then when it comes to all this, staff salary years, other allowances years, EPF and ETF years, leave encashment years, bonus years, gratuity provision years, staff welfare, no. The cost of staff training program, no. How we can allocate to one. Amortization of staff loan, no. Then these are the areas of the personal cost. Now come to next one, which is Roman 2 adjustment. The interest income from finance leases, it's interest income given. Then 1.2 million relates to lease facilities provided prior to 25th October 2024. Then prior to 25th October 2024, it's not the financial service income. This is non-financial, but interest income only given. Then this is non-financial service side, it's given. Other part, it's going for the financial services. Then since this is there, I think we can do the analysis of the revenue. Then separation of financial and non-financial service income, it's given in the section 25F. This is two categories, financial service income, other one is a non-financial service income, and the total. Then here, interest on loans and receivables as given in the question paper. Then here it is 520. It's a 520,000. Non-financial services, nothing. Interest income from Sri Lankan government bonds, 1 million. It is non-financial service. Finance leases, financial services, lease agreement entered prior to 25th October 2014. It is under normal VAT. Then this is the explanation. Finance lease agreements. Lease agreement entered prior to 25th October 2014. It's under normal VAT. In the normal VAT number, it's a total rental liable. But for our question, it has only given interest. Then we can take for our purpose, interest we can take as a non-financial. The lease agreement entered on or after 25th October 2024. Then it is the 2014 is a VAT on financial services. Then here we go, in here, the financial leases, the total amount it's given 31,163,000. Out of that, 1,200 is for the non-financial services. Then from the financial services, that amount has deducted, and this is the amount taken. And interest on hire purchase agreement financial services, Fees and commission very clearly given in the question. It's a financial services. Dividend income from financial assets. It's a financial service income. Then everything it has taken. All other. It's a, we can take it as a, this one non-financial services. Rent and the sundry income both given. And in the question, which is the this one taken, and next for a economic depreciation. Economic depreciation claim for the year ended 31st December 2023. The last year given, the 2023 amounted to 15.1 million. None of the assets were fully claimed for economic depreciation as at 31st December 2024. However, furniture that had been fully claimed for economic depreciation in the year 2022 was disposed. Now, fully claimed for the depreciation in the year 2022. Then even in 31st December 2023 one, it has not included. Then was disposed of during the year under review through the auction sale of a consideration 2 million. Then consideration given. This is non a financial service income as that we can take because the profit we cannot take. Then the following assets were purchased during the year ended 31st December 2024. Furniture, motor car, laptop, computers. Now come to the gazette to come for economic depreciation. Then in the economic depreciation rates, it has given data processing equipment and accessories, including computer software, it's 25%. Motor vehicles, it is 20%. And other machinery, plant equipment, furniture and fittings, 12.5%. Intangible assets, 10. Building, 2.67%. The statement of economic depreciation should be prepared for the whole year. These depreciation rates shall be applied on the basis of the cost and straight line method. Then in here, very clearly given is the equal installment method. It's prepared for whole year, for entire year. Then if it is for a monthly, it's a whole year we have to compute and taken into the monthly. Then restrictions imposed by the Inland Revenue Act on allowance for depreciation shall not be applied for this one. Then therefore, then the traveling purpose motor vehicles, the motor cars, we are not claiming capital allowances as per the provisions of the Inland Revenue Act. Can we apply same provision here? No. For that part, you have to provide the capital allowances. Then rates are there, explanation is there. Now come to this. Then we have consideration from the disposal of furniture. That's what we have taken. Then this is the total financial service income. This is total non-financial service income. And this is total income as per the financial statements. And only we have taken this, the 2 million. Then we need to now look at as a total turnover, what is the percentage of the financial service income? It's good to know. Then this is from the total turnover, what is my around financial service revenue. Done. Now, first one done. Now come to our computation. Now, clearly we need to take the information from the question and we have to do. Accounting profit before tax we have taken. Now, in the Gazette notification, apply this one. What an SSCL charge on the financial services we have to add back. Depreciation charge to income statement we have to add back. Emoluments payable we have to add back. Now let me come to do that. Which is in here, accounting depreciation. In the question, it has given in the paper, the accounting depreciation here, different types of the asset it has given. Assets. Then it's a PP&E, depreciation of PP&E, of course. Amortization of intangible asset, we have to give the economic depreciation on that. Then amortization we have to take. Amortization of right of use asset. Is this has any relationship with what on financial services? No. Don't take this as a depreciation. Now only this two. Why? The economic depreciation on this PP&E, it has given intangible assets in the gazette notification. Very clearly it has included as the, you can see, the eligible for the economic depreciation. Then of course it is component of that depreciation or amortization, it should be disallowed. Then it is given in the paper. Now accordingly I have taken the, which is accounting depreciation. For that, the separate note: depreciation of property, plant and equipment, amortization of intangible asset, amortization of right of use asset, not applicable for but on financial services calculation. Okay, then this is the total of the depreciation. Everything explained clearly. Then that's explain, while explaining, the amounts are taken. Then VAT on financial services charged to income statement and SSCL charged to income statement in the gazette. Then here we go. In here we need to take the SSCL and VAT on financial services charge to income statement. In this, these are the two figures charged to income statement: 18,966,000 and 3,908,000. Here we go. Both should be disallowed. And emoluments payable, since we have looked into that, this is the emoluments payable. Then staff salary, other allowance, EPF and ETF, gratuity, leave encashment, bonus, and all other three. May I pen under? If it is given, I don't know, it can be tested or not. But anyway, then we clearly have to show these things. Since it's applicable and not applicable, we need to show very clearly. Then this is the total of the emoluments payable. Then it should be the emoluments payable, it should be at. Then this is the total. Now don't ask from me, make add karanne aayi, make adu karanne aayi. Then it's given in the gazette. We are computing the value addition. The particularly this on incurred on the staff, and again when it comes to this non-cash like these things, it's eliminated. Then economic depreciation, again we know the things. I'm coming to here. Economic depreciation opening, it has given the no adjustment for that since the disposals, it's a last year applicable. Then for this, it's a 15.1 million, and furniture, it's given 3 million in that 12.5 exactly in the gazette notification amounts applied. Laptops, it is second one, which is a 2 million into a 25%. Motor car, irrespective of the restrictions in the income tax law, for 10 million, then we have to apply this 3, it has taken the 20%. Okay, then this is the total on that. There's a total on that, 17,975,000. Then this is my economic depreciation. This is my economic depreciation, and this is total, and this is the value addition prior to tax, VAT and SSCL. This is in the gazette notification, the figure up to here, value addition prior to tax. Value addition prior to tax we have computed. Now next part, which is, now obviously value addition attributable, because we are paying finance every this tax, VAT on FS and SSCL on FS, we are paying on the financial services. Then therefore, to apply it for the financial services, we should have what? We should have the value addition attributable to the financial services. Then that's the next computation. Value addition attributable to the financial services, which is in note 2, which it has given. Then very clearly in the gazette, it has provided this method, the taking the value total value addition, from that total value addition, the value addition attributable to the non-financial services we have to deduct. එහෙම කළාම automatically we are getting value addition attributable to the financial services. The same thing here, it has applied. which is we have the value addition, uh, total value addition, which is we have computed, is the answer. From this, the value addition attributable to the non-financial services, then this is the total non-financial services divided by total turnover. We have to take the figure, and this is the value addition attributable to the financial services. The same thing you can do here in the method 2, which I have taken, which is the from this is my total, this is my total value addition 261,748. From this, the 98% is my total financial service income. In both way you all can do, both way the same answer. Okay, then applied in this manner. Now come to next. Now I have to deduct very clearly this VAT on financial service and SSCL on financial service. You can see. Then we have to deduct that two separately, because now already VAT on financial services and SSCL on financial services included in our calculation. Then from this, we need to clearly deduct that, if not, is a tax on tax. Then now please understand what is the component, what is the amount of the VAT on financial services 18, what is SSCL 2.5%, what's the total of these two, it's a which is 20.5. Now already this 20.5 included in this, then it's what, 120.5. Okay, then it's 120.5. Then we have to eliminate VAT on financial services included in this value addition and the SSCL on financial services included in the value addition. Then in VAT on financial service, which is this is my value addition attributable to the financial services. On that, this should be divided by 120.5, and 18% is applicable portion on the VAT. The same manner, I have to do the total value addition attributable to the financial services. Out of that, 120.5 into 2.5, which is SSCL, then reduce, then value addition attributable to the financial services without VAT and SSCL. Now on this directly I can apply 18 and 2.5, the same answer it is come. Okay, now this is for entire 15 marks. Then this kind of the, for make sure the VAT on financial services, it has not tested after June 2022 or 1. I think June 2022 is the last time. To the, I think then it has the last time it has tested, last year, last paper it has tested in June 2022. Then therefore please note that then it's better to go through these areas and go for exam. Then this is on that 15 marks. This is on that 15 marks. If it is tested, it's a which is comparably easy for you all because it's with the open book referential material. Then this 15 marks done. Any questions? Yeah, it's a 2022 the July examination. Okay. Then on VAT on FS, I think you don't have the questions because it's straightforward pretty much. And I need to come for the second part. Which is for 10 marks. For this, what I'm going to do, I'm not going to go for the answers. Then you can receive the answers. But even here they are. But what I need to do, I need to go for the application of this particular provisions in the normal VAT and provide the explanation. Provide the explanation. Then come to this, which is what you have to do first. What you have to do in here, the requirement discuss the applicability of issues mentioned in above. Now you know there are issues mentioned in above. As per the provisions of the VAT Act, discuss the applicability, how it can be applicable. Then as per the provisions of the VAT Act, and you have to determine validity of the issues highlighted by the assistant commissioner. Then in this, the discuss, in the action verb of discuss lemma, you should have to provide logical arguments. That is compulsory. The one of the key action verb, it's normally in your paper, which is in the tier 2, in the comprehension. Then this is the action verb is discuss. Explain in detail by arguing, showing different aspects of the, for the purpose of arriving at conclusion. And don't forget, you have to provide the conclusion. Then that's why with the argument, you have to tell whether this is in line with the provisions of the VAT Act. And accordingly, the Assistant Commissioner's opinion is correct or wrong. Then that's what you have to tell. Now, here come to these areas which I really need to complete it quickly. Then in that, how many marks it has given? For it's a 10 marks. If it is 10 marks, again you have to take the 18 minutes. You have to take the 18 minutes on this. Then we will come to one by one, which is the Lucia Apparels Private Limited. Lucia is a company engaged in the business of manufacturing garments and also provides technical design services such as CAD pattern designing and 3D garments visualization since 2013. This is their principal business activity. They are involving in the garment sector. Not only the manufacturing of garments, but also they are doing the technical design services, which is on the in a AI using that relevant technology. The company supplies both the local and export markets. This is very, very important. The company supplies both the local and export markets and is registered under the both registered identified purchaser and registered identified supplier scheme with the Department of Inland Revenue. Now you know who can register as RIP and RIS as per the SWAT Gazette notification. This is the Gazette notification for suspended value-added tax. Then this is actually a really important gazette. Then from 1st October 2025 onwards, the SWAT system going to be abolished. For ඔගොල්ලන්ගේ එකට තියෙනවා no issue. It's තාමත් තියෙනවා. It's only from the 30th September 2025 or else effective from 1st October 2025. Then here, which is Lucia is currently undergoing a VAT audit for the taxable periods covering 1st April 2024 to 30th September 2024. Then, as part of the audit, the Assistant Commissioner has raised, and this is the picture of the Assistant Commissioner is coming, has raised several issues with respect to the VAT return file for the month of April 2024. Month of April 2024. This is the period of VAT audit is going, which is the 1st April 2024 to 30th September 2024. And it's a month. Why it's month? Any reason for them to go with month? The taxable period, RIP. Then and they are doing exports. Then the taxable period of 1 month, they have to go for the filing of the return. Then in that particular 1 month, which is the month in April 2024, these disputes in the VAT audit, these disputes were identified by the Assistant Commissioner. Now come to one by one. Lucia has claimed input VAT of rupees 25,000 based on tax invoice issued by Silky Button Private Limited, a company registered under simplified VAT scheme. Now the question, can you claim you being RIP, what's your provision you have to purchase from the RIS? If that person is RIS, then can you accept the tax invoice from that RIS? No, that's the first thing. It's on my purchase, no. If that person is RIS, if we have accepted a tax invoice, then can we claim the input VAT amount mentioned in that invoice? No. Why? The gazette notification is very clearly given what? RIP shall accept the RIP shall purchase only from RIS. From the RIS, RIP shall not obtain tax invoices. If such tax invoices obtained under this gazette, the paragraph, I couldn't remember the number, but under the refunds, they are not eligible to obtain the refund. And this is the input VAT shall not be claimable. This is the input VAT, it shall not be claimable. That's the first thing. This is common with the gazette. In the gazette, there is the refunds of the RIP. Then this is refunds for paragraph 5, I guess. Yeah, this is the specific regulations to which is registered identified purchaser. Specific regulations to the registered identified purchaser. Then under this, everything it has mentioned accordingly, which something prohibited they have done. There's something prohibited for them, then they have done. Then therefore is a refund in the 5.5. This very clearly mentioned the application of the refund. Then according to Gazette, they cannot claim that input VAT. As such, the assistant commissioner's view is correct. They cannot claim. That is for the first one. And for the second one, during the month, Lucia received an export order, okay, from a customer in Singapore. Due to cost considerations, the manufacturing process was subcontracted to the Malaysian company. And the finished garments were directly shipped from Malaysia to Singapore. Very, very important, these details. The finished garments were directly shipped from Malaysia to Singapore. The entire contract value of rupees 5 million, which is in US dollars 16,447, was received into Lucia's foreign, it's a company name, foreign currency bank account in Sri Lanka. Now what has happened? This transaction has declared in the VAT return under cage D, 0 rated supplies goods. Is it correct? Again the question. What's the question you have to assistant commissioner has asked? Is it a 0 rated supply? Now the question, is this a 0 rated supply? No, Lamai. This is not a 0 rated supply. Why? Then to be 0 rated, it should be compatible with the application of the section 7. This is the, it's a manufacturing, and if the manufacturing and export of goods, the utilization in outside Sri Lanka, which is the export of goods. Keep away these other things, it's the export of goods. Now, did we done the export of goods? No, we have not done so. What we have done, the contract received to us, we have outsourced to Malaysia, and Malaysia has completed, and directly from Malaysia, it has shifted to the Singapore. Then in that context, any transaction, is it happen in Sri Lanka? No. Then VAT, section 2, imposition of the value-added tax. What it has mentioned, the VAT shall be chargeable on a taxable activity conducted in Sri Lanka. Now the question, is this a taxable activity conducted in Sri Lanka? No, this is not. Then therefore, is it a 0 rated supply, which is, even the rate is 0, the 0 rate we are considering as what? Taxable supply. Then it being a taxable, it's recognized as a taxable supply, then what's the next consequence? Then the claiming of the input VAT. Then therefore, the patris of the company, which is the Lucia Apparels, it's incorrect. This is not a zero rated supply. This is excluded or is out of territory in our sea area, not included in that. Then what is the domestic tax? Then for that, it's an excluded supply. Any input what the basically transaction is offshore. Then which is the any input what if it is there, if any, it cannot be claimed. The recognition of this supply, which is excluded supply as the zero rated supplies shall not be correct from the side of the company. Then again, assistant commissioner is correct. Then it's for the second one. Then third one, Lucia also provided technical design services to Fashion World GmbH, which is the German retail company based in Germany. Now what has happened? The technical design services given, which is for the German company, the services were fully delivered from Sri Lanka via email and cloud-based collaboration tools. The total invoice value was rupees 2.5 million, which was settled in LKR by Ashika Ashik Private Limited, a Sri Lankan subsidiary of Fashion World, which is a German company. There is a Sri Lankan subsidiary. From the LKR, it has settled. The company reported this transaction in the VAT return under KHD1, zero rated supply services. Now the question, is this a zero rated supply? No, this is not a zero rated supply. Why? For me to be the zero rated supply of services, we should provide the service to person outside Sri Lanka. We can in Sri Lanka. We shall provide the service to person outside Sri Lanka and utilize outside Sri Lanka and income received in foreign currency to the account, the bank account in Sri Lanka. Now in this context, the utilization is there. It has done to the person outside Sri Lanka, yes, it is there. But when it comes to the income received in foreign currency, is it happened? No, we have received the income through LKR. Then this is what? According to VAT law, this is exempted supplies. Now what has happened? The exempted supplies, they have recognized as what? They have recognized the zero rated supply. If any input VAT relevant to this cannot be claimable. That is on the third one. And fourth one, in addition, a local purchase invoice dated 17th May 2023. I don't know how many questions. If it's a compulsory for you to do past papers. The past papers are the critical success factor for you to or make you pass. I'm urging you all, you have to do that. Then 17 March 2023, amounting to rupees 900,000 is without VAT, was included in the April month, which the audit is going on the month of April 2024. Then in that local purchases, it has included. Can we claim input VAT? No. What is the input VAT under section 22(6)? The claiming of the input VAT, what is the maximum period of claiming input VAT? On the local purchase invoice. This is a local purchase invoice. Then for a local purchase invoice, what's the maximum period of claiming of input VAT? Then it is the period which is the 12 months. Don't misunderstand this provision. It is 12 months. It's from the end of the taxable period in which that original invoice is related. Now, original invoice is on 17th March 2023. Count the 12 months, it's come to 16th March 2024. Now, we have claimed it on month of April. Can we claim that? No. What is the maximum month this can be claimed? It's on or before the end of the month of the February. You can claim because even at the 16 March ඉවර වෙලා March to return එක file කරද්දි ළමයි 12 months lapse expired. You cannot claim. Then again for this one, Assistant Commissioner is correct as per the provisions of the VAT Act. Then this is incorrect. And the fifth one, a tax invoice received for the payment made for insurance of BMW motor car of the director amounting to rupees 650,000, which is included in the local purchases. No, this cannot be included. Very clearly and again, disallowable input were the first condition. Very recently, the Department of Inland Revenue has issued a paper notice further elaborating this claiming of the input VAT with reference to non-claiming of the input VAT with reference to traveling purpose motor vehicles. This being a traveling purpose motor vehicle, you cannot claim the input VAT. Okay? Then these are the 5 scenarios typically under the normal VAT and the VAT on it's a suspended value added tax. This 5 question for 10 marks it has tested. Then this is on the explanation on that. I'm not going to go for the detailed answers. Now quickly let me come to any questions. Yeah. The answers, the particular that formatted answers, it will be sent to you all. And in the the claiming of input VAT. Give the correct answer. It's not year, it's a 12 months from the, it's a 12 months from the original invoice date, but it's prior to the, it should be claimed before it's at the end of the taxable period. Okay. Then, yes, Dakshan. Then the recording will be sent to your emails. Then I think you all need to go for sleep. Then, but please wait. Now I'm quickly starting your hunger question number 3. Okay. Then this is the end of the 2 questions, the 50% of the paper done. Now this is your, which is the most, happening questions. Happening question in your paper. Then I'm quickly doing this. Then any question? Madam, is for import purchase is it's 6 month time. No. For import purchase it's a 24 months though, not 6 months. It's a 24 months from the original date of the custom again, which is the before expiration of the taxable period. The next again 24 months complete in a taxable period. Expire when the culling we have to claim. That's the provision. It's a 24 months for normal tax. It's a local purchase tax invoices. It is 12 months. Okay, I think that's all for the questions. And come to the question 3. That's what it has mentioned. Recording දෙනවා කියපු ගමන් they are vanished. The students up to now who been patient, then they are vanished. The maximum within 45 minutes I will complete this computation question, and for balance that 20 marks I will take anyway within a maximum 1 hour I will complete. Then don't worry. Then which is in the question 3 on your pre-scene based question, then under 30 marks what you have to do, the 30 marks here, assess the balance income tax payable or refund due of EPL, which is in December 2024, your pre-scene, in respect of the year of assessment 24-25. Now, this is one of the really familiarized question to you. Then, therefore, I'm not taking much time, but let me give 1 minute, not 2 minutes, for me to take a breath. Okay, now quickly come to the question 2. Then here, which is based on the pre-scene issued for December 2024 exam. In addition to the information provided in the common pre-scene in relation to Ecom Logistics PLC, ERP, then the following additional information for the year ended 31st March 2025 is also available. This is your testable year of assessment for that financial year. The detailed unaudited income statement of ELP for the year ended 31st March 2025 is as follows. Then from this, revenue from the contracts with customers, cost of sales given, gross profit given, other income, all supported by the notes. Then we will need to go for each notes for us to take a further information. And selling and distribution expenses, administrative expenses, finance cost, finance income, share of loss of the associated. Then this is the loss which it has given. 61, then it's the associated company, the loss it has recorded for our share. This for tax, this shall not be allowable deduction. Then we have the profit before tax. We have the profit before tax, and this is my starting figure. Now I'm quickly coming to this, which is the in business income calculation. Then this is the normal format which in a convenient manner which you all can use. But if you are in family, this is again which I need to tell, it's in rupees millions. Then if you are really familiarized with that, the add and less method, please go to. It doesn't matter. Whatever the convenient method you can apply. In practical, we are going for that add and less method. Then for in the exam, it has taken in the exam it has taken in this manner for you to apply in a very, it's a time saving, as a time saving mechanism. But however, in practically we are going, we are starting from the PPT, but we need to add the disallowable and less, and that format is there. Okay, then let me come to this one. We have to start from the 28,874 and this one 61 million we have to disallow first. Now come to here 28,874 and loss from the associate, it should be disallowed. And next one, which is I need to read the all information. Dividend income given, I'm not doing any adjustment here until coming for the additional information, because all supporting information, it's in the paper, in all the papers it has given under additional information. Dividend income, profit on sale of fixed assets, then gain from disposal of shares listed on the Colombo Stock Exchange, exchange gain net, unrealized gain on unit trust investment. Now these are included in other income. And extract of the certain expenses recorded under cost of sales, administration expenses, and selling and distribution expenses. We have export expenses, import expenses, which is a director fee. Now when it comes to this pre-scene, it's a Ecom Logistics. It has given, then they are doing multiple activities. Then this is the pre-scene. In that pre-scene information here, it is the Ecom Logistics PLC, and in the principal business activities there is a company OSL, which is a non-vessel cargo company, and they are doing all the activities with reference to the logistics activities. Okay, then it's a brief understanding, but we can do the question even without that. Then here, but in your case, the knowing of the principal business activities and everything are very, very critical. Na? For this one, since this is for last examination pre-scene, then that's why we cannot do pre-scene in fully and come to the question. That's why only background information given. Then export expenses, import director fee, staff salaries and wages, and vehicle allowance, EPF and ETF, advertising and business promotion, provision for retirement benefit, bad debts written off, provision for doubtful debts, stamp duty, staff welfare, improvements, consultancy fee, research and development expenses, CSR expenses, depreciation and amortization, amortization of ROU assets, fines and penalties, legal fees, valuation fees, professional fees, foreign traveling expenses, written off of long-term loan due from OSL. The OSL is the associate company, and the finance cost, interest on loans, interest on ROU lease liability, or the interest. Finance income, we have interest on investment in treasury bills and bonds, interest on fixed deposits, interest on foreign currency savings. Now all these things are there. Then come to this one, which is you are provided with the following further information. Then I'm starting from this further information. As per the dividend warrants, an amount 55 million was declared out of the dividend received, and balance is net of the advance income tax, then, which is very clearly, I'm coming to here, the dividend income. It is included in other income, which is in profit before tax. First thing, I need to remove it from the profit before tax, and secondly, I need to take it under investment income, which is a final withholding and exempted. Dividend income, it has removed from the profit before tax, and under investment income, liable dividends, which is which out of the deduction of the 15% of the final withholding and the exempt dividend. Then even it's not form part of the taxable income, my advice, you have to very clearly mention what should be exempted and what should be liable. Okay, that is on dividend. And the next one, which is here, the company disposed the following two assets during the financial year ended 31st March 2025. Two machineries which purchased in 2021, the motor lorry which purchased in 21-22. The cost given, consideration given. For this, what you have to do, you have to compute these. Both are the depreciable assets. Then what you have to do, you have to compute balance in allowance or assessable charge. Then let me come to this in the income statement. Here, it has given the profit on sale of disposal of fixed asset. Then I need to remove the profit, and assessable charge or balance in allowance we have to tax. Then profit is a 1,050,000. Then I have to go for the balance in allowance or assessable charge, which is it's a machinery and motor lorry. Now the two considerations it has given in the question, which is in this adjustment. It's a consideration 450 and 750 millions. Then here we go. It is in the consideration, this total I was wonder whether, okay, 450 and 750, and cost is given, and which is the machinery has purchased in 2021. Then what's the basic principle for the year of disposal? No capital allowances. Year of purchase, we are giving capital allowances. Then here 2021 purchase, 2021, 21, 22, 22, 23, 23, 24. Then in 24-25 we are selling, entire 4 years capital allowances given. Then I have the which is the tax written down value. I'm not going to elaborate how you are going to compute the assessable charge or balance in allowance. These are fundamentals. Then we have consideration. Then you need to take the tax written down value. How to compute the tax written down value? The cost minus the capital allowances claimed other than the year of disposal. Why? The year of disposal, we are not providing the capital allowances. Then under that basis we have taken, and for motor lorry, it has acquired in 21-22. Okay, then the cost is 400 million. Then in that, the 21, 22, 22, 23, 23, 24. The 3 years, its capital allowances given. Then this is my cost divided by how many years you can give capital allowances for motor lorry. It's a 5 years. That into 3. Then this is my tax written down value. Then both I have tax written down value of 220. I have sold these two assets for 1.2 million. Then this is my assessable charge. The 980. Then here we go, which is the 980. And the next adjustment, which is the exchange gain. The exchange gain is the net amount after adjusting both exchange gains and losses, details of which are as follows. In other income, which is the exchange gain net amount given. Now the breakup for that given. Now you all know about the application of the exchange gain. This rapidly tested in the past papers. Then foreign currency exchange gain, how it's the 8 million it has taken. Realized gain on receipts of the debtor. This is a part of the business income. Realized gain relating to settlement of creditors. This is deductible. Unrealized gain relating to debtor and creditor valuation. The translation 31st March 2025, this is a gain. This shall not be taxed. Unrealized loss relating to valuation of foreign currency savings account. This is unrealized loss, shall not be deductible. Then while these two, deducting and this one, taking into the part of the business income, this two, the unrealized gain, not taxable, unrealized loss shall not be deductible. Then for this, you have to adjust in our computation here, which is we need to come for a compensation, bad debts, and the, I think, yeah, exchange gain loss. Realized gain relating to receipts from debtors, it's a part of the business income. Realized loss relating to settlement of the creditors, then deductible when computing business income. Unrealized gain relating to debtor and creditor valuation, it cannot be taxed. It should be removed from the profit before tax. And unrealized loss relating to valuation of foreign currency saving account, it shall not be deductible. Now this is all four we have done. This all four we have done. Then let me come to the paper, and here I need to tick this, which is, yeah, it has done. And the next adjustment, which is import expenses, include rupees 20 million house construction material imported for the new house constructed of Mr. Roshan. Mr. Roshan is one of the directors of these companies. Then this is what? The house construction personal expenditure, which has included in the import expense. In import expense here, this one, the personal expenditure incurred, that 20 million, it should be the disallowed. Import expense incurred for personal construction activities. Under section 197, it is domestic expense. Under section 10, subsection 1b, it should be disallowed. And next adjustment, which is the next one, apart from sum of rupees 200 million, apart from the sum of rupees 200 million, advance personal income tax, APIT has not been deducted on the remaining balance of director's fee. Now when it comes to our in income statement, the director's fees, the amount it has given as 500 million. Out of this 500 million, the 200 million, the APIT has deducted. The 200 million, the APIT. The 200 million APIT has been deducted. Then the director fee relevant to the rupees 200 million, APIT has deducted. The balance 300 million in totally disallow. Why? The not deduction of the APIT director fee, APIT has not been deducted. Then for this, the application of the section 10, subsection 2, application of the section 10, subsection 2, accordingly, it shall be disallowed. Then the next adjustment, which is the advertising and business promotion expenses incurred on staff recruitment, commercial advertising on television and social media, entirely allowable. Gratuity paid during the year amounting is rupees 4,125,000. Then while it is the gratuity which is in the 4,125,000, which is the payment of gratuity, it is an allowable deduction, and the provision of gratuity, the gratuity provision, retirement provision for retirement benefit obligation, then it is rupees 8 million, it shall be disallowed. Rupees 8 million, it shall be disallowed. Okay. Then that is there. And next one, in the a customer significantly impacted by the financial hardship has been classified under bad debts and subsequently written off. However, ELP has not undertaken sufficient recovery action before proceeding with the bad debts written off. Then in bad debt written off, which in the income statement, here the bad debts written off, the 25, the legal actions not taken, this should be disallowed. This should be disallowed being a reason that the relevant legal actions has not obtained. Okay. Then that also done, and the next one, which is the stamp duty was paid in relation to the purchase of the land by Mr. Kamal Fernando in his personal capacity. Kamal Fernando also a director cum shareholder of this ELP. Then we have the stamp duty. Then it's a 3 million. It shall be disallowed because it has paid on behalf of the personal expenditure. Even the stamp duty, even is related to company, it has charged to income statement, it shall not be deductible. The reason which is that stamp duty is what? It's a capital nature expenditure. Okay. And the next one, next adjustment, which is the staff salaries and wages, include a compensation payment of rupees 900,000 provided to former employee in considering his employment, his economic circumstances. This payment was made in cash. This payment was made in cash and directly deposited to his savings account. Sorry, the original deposit slip has been duly attached to the wages file for references. This one, which is the compensation payment made in cash more than rupees 500,000 included in the staff salary, you cannot deduct. The section 10 subsection 2A in the salaries and wages it has included, then in that particularly this rupees 900,000 it should be disallowed. Then this is compensation including staff salary and wages, payment has made in cash, it's rupees 900,000. And it's a please go through this area, section 10.2A application, per day single transaction, it's a aggregate value is rupees 500,000 no more, then that application you should need to know carefully. And which is the next one, valuation fees were incurred in connection with the valuation of newly acquired land. This is a capital nature. Then it is, we have to disallow, which is the valuation fee, 8 million, this should be disallowed. The valuation fee 8 million, it should be disallowed, which is it being a capital nature. And next one, the next adjustment, then which is here, the provision for bad debts pertains to the amount allocated during the year for debtors whose outstanding balance exceeds a credit period of 180 days. adjusted for bad debts recoveries amounting to rupees 38 million, which had been allowed as an actual written off in the previous year of assessment. Now what has happened? The provision for bad debts, this is talking about the provision for bad debts pertaining to the amount allocated during the year for the long outstanding debtor balance exceed the credit period 180 days. Done. Adjusted for this bad debt provision, adjusted with the bad debt recoveries amounting to rupees 38 million. Lamai, which had been allowed as the actual written off in previous years of assessment. Now, previously bad debt written off. Then it's a P&L debit, income statement debit, and it's a credited to the debtor. Then subsequently it has received the bank debit, and to credit we don't have a trade debtor. Now it's our other income. Then that other income, instead of crediting the other income, the bad debt provision which we have debited to income statement, it has netted. Then therefore we need to disallow very clearly particularly provision, and this 38 million is the part of the business income. Okay, then that adjustment we have to do, which is the bad debt provision it has given here, which is provision for doubtful debts. Then in that, when it comes to the bad debt provision, it's a net figure. It's a given, it's a net figure 100, but 38 should be added. If 38 million added only, we are getting the correct amount. Then, of course, recovery of bad debts, then it's coming part of the business income. We don't have to do anything on that. Then the provision is netted from that. We have to tax the provision. Then already, if we are taking that, which is the amount which it has received, then it is included in the business income. It should be part and parcel of our business income. Okay. Then the next one, which is the stamp. Sorry. It's a piano. Then which this machinery originally acquired during the year of assessment 1819 at a cost of rupees 28 million was improved during the year under review at the additional cost of rupees 15 million. What the asset, which depreciable asset subject to the improvement, it's a machinery. Then it is acquired in 1819. Machinery, what's the number of years of the capital allowances? 5 years. 18, 19, 19, 20, 20, 21, 21, 22, 22, 23. Up to 22, 23. Entire useful lifetime, it has over. For the fully, we have provided the capital allowances. Then this is the asset. Now in the improvement, we need to look at whether this is we need to look at what's the previous year tax written down value. For this machinery, we don't have previous year's tax written down value. Then we need to go for that 3 years provision, which it has given in the law. Then in the improvement expenses in the income statement, this is the improvements, which is the 15 million. Then on here, this 15 million, then I need to come for this one. Improvement cost, which is a machinery purchase in 2018-19. Previous year's tax written down value is 0. It's already, the capital allowance is fully claimed. Then no tax written down value for previous year. Apply section 18 subsection 4 under the amended act number 45 of 2022. Actual improvement 15. Out of that we can claim maximum 3 years. Then the 1/3 of the actual improvement cost we have to take, and the 10 million should be disallowed. Then here we go, which is the disallowable improvement cost. As mentioned in the working 2, it should be the 10 million. It should be 10 million. The amendment, after the amendment in 2022, then this is there. If the tax written down value of the assets are 0, then how we are going to apply? Then this is for other than class 4 asset category. For the class 4 asset category, it's a 12 years. And the next adjustment, the vehicle allowance has not been included as a benefit subject to advanced personal income tax, and no employee has paid personal income tax on this benefit. This should be disallowed. Section 10 subsection 2. And even in this is coming under domestic expenditure also. The benefit is not for the relevant benefit. The beneficial owner, which is the employees, are not paid tax. Then entire 10 million, it shall be disallowed. Vehicle allowance not subject to APIT. Then the next adjustment, which is the right of use lease asset and corresponding lease liability, represent the SLFRS 16 adjustment in relation to lease agreement entered into the use of the warehouse. The actual use rental paid during the year amounting to 510 million. Now let me come to this adjustments. Actual lease rental paid rupees 510 million. Allowable deduction. And when it comes to the interest on ROU lease liability should be disallowed. Second one, and the amortization of the ROUA asset should be disallowed. Now come to these adjustments, which is the, when it comes to this one, the ROU adjustments, amortization of ROUA, it is 65 million, it should be disallowed. Then interest on ROUA ROU liability, it should be disallowed. And the actual lease rentals paid, here we go. Actual lease rentals paid on ROUA, it's a 510. Done. And next one, which is the EPF and ETF expenses include payment of rupees 20 million applicable to the financial year ended 31st March 2023. This payment was made in the current financial year after it was determined that certain employees' salary increments had not been considered previously. Now this is the EPF, ETF, it includes 20 million but not relevant for the production of income during the year. We are doing chargeability of the tax for the year of assessment. Then this is not the expenditure which it has incurred during the year, it's for the previous year. Then this 20 million which is included in the EPF and ETF expense, this it shall be disallowed. It shall be disallowed. Then for this one, which is the payment of EPF and ETF for the financial year 22-23, it's not the expense for our year of assessment. And next one, which is the here, research and development expenses were incurred to enhance the route optimization and real-time tracking capabilities of the company logistics management system, with the objective of improving operational efficiency and support business growth. Totally within the section 15 application, which is the improvement of the process. Then under the research and development expenses, research and development entire part, it shall be allowable deduction. Then here, if we have taken the R&D expenses application, R&D expense, it is the compatible with the requirement of the section 15. Therefore, it is an what? Allowable deduction. Then next one, next adjustment here, which is CSR expenses incurred during the year for the donation made to Ministry of Health, support of the public healthcare initiative. Anywhere the CSR expenses when computing the business income, CSR expenses shall be disallowed. Then here we go, which is a 30 million, the CSR expense, it shall be disallowed. And when it comes to our tax computation, again, this is the tax computation, then ecom logistics for year of assessment 24-25. And I'm always giving this advice. In the question 3 is one of the highest marks allocated question in your paper. And for this one, Lamai, your format, where the visibility of the answer, clarity of the answer, everything should be there. Then අතපිහදන කඩදාසි කොලේ නෙමෙයි ඔයාගේ paper එක. It is your answer script. You have to respect to that, and very clearly everything you have to present to the marker according to the requirement of the examiner. Okay. Then that is on the CSR expenses, which is 30 million, and it should be disallowed and it should be allowed as the which is the qualifying payments deduction. Then the details of the assets acquired during the year of assessment are as follows. Land, no capital allowances. It's a capital asset of the business, not a depreciable asset. Building 20 years, plant and machinery 5 years, computer and accessories 5. Intangible assets, we need to look at the actual useful lifetime given or not. Motor vehicles, we need to look at what's the type. Capital work in progress, not a depreciable asset. The estimated useful lifetime of the intangible asset 8. For intangible asset, you have to take the capital allowances at the number of years of the 8. The company purchased motor vehicles amounting to rupees 50 million during the year for the use of by its executive staff, which classified under motor vehicles. For this one, for executive staff, the 50 million is there. We cannot claim capital allowances on that. And the remaining balance relates to the acquisition of the lorry used for transportation purpose. Of course, the balance 30 million, we can claim the capital allowances. Now come to the capital allowances on additions during the year. Land not eligible for capital allowances. Then for building, which is it's a 60 divided by 60 million divided by 20 million. Is it 60? Then yeah. Then next one, which is the plant and machinery, 20 million divided by 5. And for motor vehicle, 80 million. 50 million is for the traveling purpose. Then balance 30 is for the lorry. Then it's a computer and accessories, 5 years. Intangible asset, very clear, it's 8 years. And WIP, it's not a depreciable asset. Then no capital allowances on that. Then this is on the capital allowance on the additions during the year. Now come to next one, which is the capital allowances on the capital allowances on opening, which is 23-24, it was 180 million. None of the assets were fully depreciated for the taxation by end of the year of assessment 23-24. I think we can complete this. Then, which is the 180 million is the opening capital allowance. Then for that, you have to do the disposal adjustment. Then the capital allowance in the opening, 1.8 million during the year. We have 2 disposals, which is in machinery and lorry. The both capital allowances were included in the last year, which is opening capital allowance thing. Then you have to remove that 2 capital allowances, which is on the machinery from the cost. It's divided by 5, and motor lorry, it's divided by the again 5, because both years, the previous year 23-24, this is opening one. In this opening one, for the machinery and lorry, already capital allowances claimed, and that claimed amount included in this. Okay. Then therefore, for the capital allowances on opening depreciable asset, from the opening one, we have to do the disposal adjustments. And next one, fines and penalties incurred during the year relate to delays in the remittance of EPF and ETF contribution to the relevant statutory bodies, as well as late payment penalties to Department of Inland Revenue, because EPF, it's an issue. Then they are paying that EPF and ETF, which is the penalties. Which one? It is written off and professional fee, fines and penalties, 32 million, it should be disallowed. Then 32 million, it should be disallowed. Here we go. The fines and penalty which incurred. And the next one, which is the next adjustment, we are in the last 6 or 7 adjustments. Then consultancy fees, legal fees were incurred in relation to legal services obtained for, what's the question? Any question, Lamai? What's the issue? The amount. Okay. Let me adjust that. Then it's rupees 180 million. Sorry. Then let me take it. It's rupees 180. Okay. It's rupees 180 million and this adjusted. I'm really sorry for that. Thank you for quoting on that. And y'all is still active. Then it's really good. And the fines and penalties and legal expenses were incurred in relation to the legal services obtained for a recovery of doubtful debts. Please look at the nature of the expenditure and proceedings before the Labour Tribunal. The total amount was paid to Analia Partners, a legal firm registered as a partnership. Now on this, legal expenses incurred for the production of income to recover the bad debts and for the labor tribunal cases. And again, when it comes to, it's paid to the partnership. Now, if this is same amount, the legal expenses, what's the amount? It's in millions. If this legal expenses, Lama, if it is paid for, it's a 22 million. If it is paid for individual, then the relevant, the WHT of 5% shall be deducted. But in being the partnership, then no issue. That 22 million we can deduct. Then in here, anything with reference to the legal expense, which I think it is there. The legal expenses, it is an allowable deduction. The reason it has explained, okay? Then the next one, which is the consultancy fees, include a cash payment of rupees 3 million made in January 2025 to Mr. Pereira, an individual ERP consultant, for services rendered in connection with system implementation. The applicable withholding tax was duly deducted and remitted to Department of Inland Revenue on or before the statutory due date. එහෙනම් ඇයි මේක දීලා තියෙන්නේ? What's the reason of giving this amount? Consultancy fee include a cash payment. Can we make this as a allowable deduction? No, we cannot. Why? Because it has done in cash. Then it's a single transaction for a one person, the application of the section 10 subsection 2A. Then very clearly this 3 million which was included in the consultancy fee, it shall not be deductible. It shall not be deductible. Then when it comes to here, the consultancy fee 3 million is a not application of the section 2A. Lamai, this single transaction, per day transaction, the section 10 2A and section 10.2 is a critical. No? It is critical to remember and apply. Then next one, which is the foreign traveling expenses, include an amount rupees 10.5 million incurred in relation to personal traveling expenses by the director. For foreign traveling, the 10.5 million, which is foreign traveling, 10.5 shall be disallowed. It is domestic expenditure. It is domestic expenditure. Then what is the next adjustment which we need to look at? Which is the Total saving deposit interest represent the interest income received in foreign currency. Then in the interest income here, the foreign currency interest income, then it's not form part of the taxable or business income. Then this 5, we have to remove it from the interest income on foreign currency. It's exempted from income tax. Which is the savings interest or savings accounts are effectively connected to the business, then therefore not it's categorized under investment income. And next one, which is the EPL has granted a loan to OSL, that associated company. However, due to OSL's continued financial losses and inability to settle the outstanding balance, the loan was deemed irrecoverable and was written off in the financial year 31st March 2025. Where is that amount? It was in here, written off of long-term loan due from OSL. The related party loan written off, this shall be disallowed, not allowed to deduct. The domestic transfer pricing, then this is this is the non-satisfying of a receivable amount. And this is, if this allowed, anyone can do this. The profit shifting arrangements, then this is shall be disallowed. And next one, which is the staff welfare expenses, include 8 million incurred for a 5-day staff training program. Very well. Of this amount, 1.5 million was designated for the provision of liquor and tobacco during the final day dinner event. Anyway, from this staff welfare in our financial, which is the performance, which is staff welfare, this one, from this 25 million, the provision of the liquor and tobacco, the 1.5 million, it should be disallowed. It should be disallowed somewhere here, okay? Staff welfare, liquor and tobacco, the section 10, subsection 2b, application of what? Entertainment expenses, okay? And the next, which is the professional fee, include a payment of rupees 2 million made to digital supply chain consultant. At the consultants required, the applicable withholding tax was not deducted. If it is done so, then I have to bear the 30% on this. This 2 million, which is included in the professional fee, it should be disallowed. Where is the professional fee? This is the 2 million, it shall be disallowed. Okay? The professional fee on this, it should be disallowed. And what next? Which is the EPL has utilized both loan and overdraft facility for the purpose of directly related to generation of the company's income. Then let me come to this, the section 12, which has satisfied. Then thereby, for the application in the finance cost, we have interest on loans, interest on OD, both utilized for the production of income. Then in the pre-scene information lemma, it's given, which is the computation of disallowable finance cost. In that, the pre-scene in the financial position, it has given stated capital plus reserves into 4 times other than revaluation reserve. Then in that context, which is the stated capital is 5,000 million and other reserves and all is the 4 times 328 million. Then 328,756 million. And actual borrowing as per the given details, even in the not unseen, even in the pre-seen details, then it is the 30,150,000. Then you can see the gap. All this has taken from where? All this has taken from this financial information which given in here, then stated capital, reserves and revaluation other than revaluation reserve, and for the details of the borrowing and which is a lease payable එකට වෙනම දීලා නැති හින්දා because current and non-current it has taken. Okay, I think it's understandable. Then therefore for the borrowing cost, what has happened? Then for the this one, the excess over maximum borrowing limit, there is no excess. Then entire the borrowing, it is allowable deduction. Okay. Then disallowable finance cost, nothing to disallow, and as or within the maximum borrowing limit as mentioned in the working for. I guess that paper is uniformly there. Oh my goodness. What has happened to the paper? Let me take the paper again. I'm sorry. Give me 1 minute. Okay, now I think it's okay, but that what we have marked and everything, it is not there, but okay. Then we were in here, which is overdrafting, and total amount of rupees 3.8 million was paid as the income tax quarterly installment payment for the year of assessment 24-25. Then this is a adjustment which we have to do. Then it is my installment payment, quarterly installment payment. Then it's a 3.6 million as it is. Sorry, it's a 3.8 million. 3.8 million. It has the quarterly installment payments done. All the adjustments done, but I need to take 5 minutes and I need to revisit the entire income statement in everything if we have taken. Then if so, we are good. And from this, quickly, everything taken, which is this one taken, and here dividend taken, profit on sale of fixed asset taken, gain from disposal of shares not taken, then it is 903. It should be part of the investment income, but it is exempted. Then in this gain from disposal of listed shares 903, it should be removed from the business income, and gain from disposal of listed shares under third schedule para H, it is exempted. Then it should be taken. And the next one, exchange gain done, unrealized gain on unit trust investment is not taxable. It's now included in the profit before tax. Then you need to remove it from the profit before tax, which is the unrealized gain on the unit trust investment. Here we go. Then the next one, accordingly, all the things for the other income it has considered. Everything taken here. EPF, advertising, provision of retirement benefit, bad debts, doubtful debts, stamp duty, staff welfare, improvement, consultancy, R&D, CSR, depreciation and amortization, 200 million we have to declare now. Then this is depreciation and amortization. It is 200 million. And next. What's the next? Then which is amortization of the ROUA we have taken. Fines and penalty, legal fees, valuation, professional fee, foreign travel in written off of the OSL, everything it has taken. Interest on loans, this was adjusted. Now the for this one taken, interest on investment in treasury bills and bonds, and the interest on fixed deposits. Entire 62. This is what this is the investment income, and it should be a T-bill and T-bonds interest and the fixed deposit we have to take. I think other than, yeah, everything we have considered. Nothing missed. All the adjustments and everything. Now we can finally conclude the business income, the plus and minus. If you are not familiarized with this method, go with the add and less, then fixed deposit interest and the treasury bill and treasury bond interest. Only withholding tax application for this, the 5% on this fixed deposit. Don't go and apply the withholding tax on the secondary market instruments for T-bill and T-bonds. Then 0.6, it should be in here, withholding tax on interest and the fixed deposits. Then we have the business income, 31,397,000. Okay, investment income, which is a 62 million, altogether 31 this amount. And we have to deduct the qualifying payments, 30 taxable income is there, and apply 30% on this taxable income. Here we go, these are the tax credit and the balance tax payable 5,205,628. This question include every adjustments which necessary. Then this is the end of for the 30 marks question. I need only 20 minutes. Then then this is for the 30 marks question. My humble request from you all, even how many adjustment, even it's a 30 marks lama, it's only 30 marks. Then don't struggle your time in this 30 marks question. Other than the permitted time, it's a 30 minutes and it's 1.8 minutes per mark, 54 minutes. You are taking yourself to the fail your examination. Okay, the questions I mean for opening, keep your eyes open. My eyes open. Yes, Lama. It's really good. It's really good. Chamat, thank you very much by caring of myself in a high level, even in the pre-scene discussion. You had the same things. Then thank you. I'm in eye opener. Then of course it's highly absorbed. Now, then will you believe if I say 30 out of 30? Madam, why not? Then try, you can obtain 30 out of 30. If you think to do something, then I'm talking about good things, not for the bad things. If you think to do something which not harmful to others, and if you try on that with your commitment and everything, yes, you can achieve. Okay. Then now come to rest of the part. The two writing part of the question. I'm not coming to the long answer, but as it is, I need to explain the application of this, and the detailed answer will be available for you all. Then here, for how many marks? It's for the 10 marks, the first part. The question 3B Roman 1, for the 10 marks, it has asked what? You are required to discuss. Now you know what is the action verb, the means of the discuss, the tax implications of the gain to be earned from the proposed sale of land, in particular assess whether such gains would be liable to income tax under provisions of the Inland Revenue Act number 24 of 2017 with specific reference to. You have to recognize type of the assessable income into which such gain would fall, the appropriate categorization of the asset for tax purpose and the method of calculation of gain. These things 1, 2, 3. Your answer should also refer to relevant case law principles and support the tax treatment of the transaction. This relevant case law principle should be support to the tax treatment. Now for all of 10 marks, it's a 18 minutes. On this 18 minutes to utilize effectively, I need to carefully read the facts. EPL required acquired a plot of land in Demetergoda in early April 2024. EPL acquired a plot of land in Demetergoda in early April 2024 with the intention of constructing a warehouse. Now this is the intention, which is a constructing a warehouse. For use in its logistic operations, the principal business combined to principal business activity. However, as of the end of the financial year, construction had not commenced. Then it's April 2024. Then in 31st March 2025, construction not commenced. Due to the sharp increase in property value in the area over a shorter period, the board of directors has now decided to change the purpose of the hold in the land. Change the purpose. Now they are going to change the intention. The new plan involves subdividing the land into 10 separate lots, undertaking necessary development activities. Development activities are there, and selling each lot individually. The estimated cost of improvement relating to development is 10 million, and the implementation of this plan is expected to be in June. You are the tax consultant of EPL. The board of directors seeks your advice on following. Following what? You have to discuss whether this is a gain subject to income tax. If it is subject to income tax, what is the type of taxable income? Then for the appropriate categorization of this asset for tax purpose and how to compute the gain, and your answer should support it with relevant case law provisions. Now come to this one, which is the I will just analyze the situation. Question 3b Roman 1. Now there is a subject matter. I will quickly do this. There is a subject matter. Subject matter is a land. The land has obtained in first to the purpose or initial purpose of the land. Initial purpose of the land to construct a logistic warehouse. Construct a logistic warehouse. Now what has happened? Immediately, that means this has a year of purchase, then 2024. It's if I have taken April 2024. Now what has happened? End of the financial year, then it's at 31st March 2025, they are going to sell the land. Then in this sales, what's the reason for selling? Reason for selling, the intended construction has not done, and in the same manner, the price of the land has increased. Now, these are the which is the things we can take. Now, all these, with this all information, come to the answer. Then is the reason is to price of the land has increased. To take the maximum benefit on this increased price of the land, then what are they are going to do? They are doing the improvement. They are doing improvement to land. In the improvement to land, it's a 10 million it has done. What's the main improvement they are doing? The block the land. They have block out the land. They have block out the land to the 10 plots. Okay. Now these are the information given in that question is whether, now let me come to answer format. Answer format. Then in that answer format, then I need to come how you are going to take. Now here it's asking the, if this is now first one, if this is a tax implication on the gain to be earned from the proposed sale of land, then while you are coming to that and assess whether such gain would be liable to income tax under the provisions of the Inland Revenue Act, specifying. Now discuss tax implication on the gain to be earned and the type of assessable income. Now for the first one, in this transaction, I need to come for the first thing, which is I need to look at what is the business income. The definition of the business income. Definition of business income. It's defined in section 195. It's a trade, profession, vocation, no isolated transaction which is embedded in the business characters. Now what has happened? We need to look at, then this is a selling of the land. What is my company? It's a logistic company. Being a logistic company, they are selling the land. And what they are doing, they are block out the land. Now this is maybe their first transaction on this isolated transaction, but it included the business characters. Now in next I am analyzing what are the, if this is an isolated transaction of a logistic business, then what are the, for me to tell it as a business income, what are the characteristics? What are the characteristics of the transaction? The one characteristic of the transaction, it has the profit motive. Why it's a profit motive? The reason, if I need to just sell it as as it is, then of course I can sell without blocking. Now it has blocked, then my profit motive. And next one, which I have doing this activity within the shorter period of time. It's a 1 year. Shorter period of time. Then the intention has changed. Intention has changed to construct a depreciable asset, which is a warehouse, depreciable asset, and construct and change. It's the first thing is to the construction of warehouse. Now they are going for a disposal. Now all these things, based on all these things, then this is the part of the business income. Then if it is so, the third one, we need to look at what's the definition of the business, and we know what they have done. Accordingly, for a shorter period of time, for the increase of the price, their profit motive, and with the motivation they are engaging in with this transaction and incurred 10 million of the improvement expense to enhance the value of this land. Then this is what? This is now this is a land. This is not the investment asset. This is the capital asset used for the business. Capital asset used for the business. Then this is business asset, and even the intention has changed for the disposal, but again they are disposing with it's not a bare at the bare land disposal, they are floating it, and all the things is a business characters embedded. Then capital asset of the business they are disposing. Then this is the part of the assessable income, and under section 6 subsection 2c. Okay, and the next one, the definition, it's asking what is the type of the asset. It is the capital asset of the business. Capital asset of the business. It's a for the usage of the business it has taken. But suddenly intention change, but it's still it's in our where it has recorded land. It's in my property, plant and equipment. Then this is the capital asset of the business. Then the definition of the capital asset as given in again section 195. That's next one. The applicable income tax rate. Applicable income tax rate, the 30%. How to compute the gain? Sixth one. How to compute the gain? Then gain will be computed based on the consideration minus cost. Then cost as the cost. The improvement expense is a part of the cost. Improvement cost is the part of this initial cost. Let me take like this. The initial cost plus improvement. This kind of a transaction you all have to think a lot. Then this is the initial cost plus improvement cost. I would say the application of the sections 36, 37, 30. This is not a capital gain. Gain capital gain then on that gain, the applicable tax rate is a 30%. Then finally the application of the case law provision, very famous, which is the Ram Isvara versus CIR. Okay. Then this is the answer format. This is for the 10 marks. Taking the subject matter, I think. Relevant case law taken, method of calculation taken, category of the asset taken, which assessable income taken, discuss the implication of the gain to earn. It's a part of the business income, everything covered. And the Roman 2, it's asking, explain the value-added tax and SSCL application on the arising from the proposed transaction with specific reference to the VAT Act and the SSCL Act. First thing, my SSCL Act, the disposal of the assets not covered. And for the VAT, bare land, the market value of the bare land, it will not be taxed, but the improvement will be taxed. This is for the 4 marks. And for that, this is the answer, which is a question 3B, Roman 2. And application of value-added tax on disposal of land. We need to go for the value of supply under section 5. These are highly practical things. Then therefore, it's a value of supply, the taxable activity, and the disallowing of the input VAT. All these things are fundamental. Then as per section 5, value of supply, when the recipient is registered person. If the consideration is in money, the total consideration less VAT which not be less than the open market value. This is on the fundamental thing on if the person registered for VAT, how to determine open market value. Open market value defined in section 83 of the VAT Act. Then that's for the first. As per the section 5 subsection 7, which is the supply of land and improvements, okay, in that thereon shall be computed as consideration minus market value of the bare land at the time of sale plus cost of improvement as at the 1st April 1998. Then in that, our case, as at නෙමෙයි, we have after that. And the consideration should be not less than the open market value. Accordingly, the value of the land at the time of supply must be excluded when determining the value of supply. Hence, the improvement made after 31st March 1998, in this instance, improvement after purchase of the land in 2024. Now, improvement may be done in 2025, but after purchase in 2024, have to be considered as a value of supply. Then improvement, what the main message, the improvement done after 1st April 1998, VAT subject to VAT. SSCL very clearly, these are the four types of the turnover categories. Then the disposal of the assets, even capital assets, even mukukma define in the SSCL, it's a turnover tax. Then therefore, accordingly for this fixed asset disposal, fixed asset which is a land disposal, the SSCL is not applicable. Any fixed asset disposal, the SSCL will not be applicable. Okay, this is on the SSCL part. That is for 14 marks totally. And this is on 6 marks. Even I don't need to do this. Even this is a very, again, no, I will do. Then come to this part, question 3. Part C is asking, you are a tax consultant in the company and explain the following. Then in that, explain the following: exposure to transfer pricing, ability of claiming of income tax refund, return filing due date, applicability of the time bar provision for the return submitted for 23-24, penalty application of the non-fund. These are straightforward. But come to the question, which is ELP in the process of acquiring a packaging company, which will be operated as a wholly owned subsidiary post-acquisition. After acquisition, it's my wholly owned subsidiary. The business of the acquired company will continue as usual, with the strategic objective of integrating all logistics related packaging function of ELP under this entity. At the time of this communication, the pricing arrangements for intercompany transaction between ELP and packaging subsidiary have not yet been finalized. The packaging company has filed its return of income for the year of assessment 23-24 on 15 December 2024. What's the due date, Lamai? On or before or within 8 months. At the end of the year of assessment, you have to file. Then 8 months come to 30th November 2024. Now, it has filed on 15 December 2024. And following carried forward balances were the reported in the return. The brought forward business loss from 22-23 19.5 income tax refund. That's all. Exposure to transfer pricing. Tell me, is there exposure to transfer pricing? Yes. Section 77, which is the domestic transfer pricing. If we have taken first one, the exposure to I will just give the summary answers. Exposure to transfer pricing, then yes, it has a domestic transfer pricing. Domestic transfer pricing, why? In the section 77 and the Gazette notification. the gazette notification, it is here the regulations of the transfer pricing, which is 2217/7. In that, in the regulation for domestic transfer pricing satisfied. Why? The one person is incurring the immediately preceding year, which is a brought forward losses are there. Then the person who they are going to the as a logistic hub for the packaging now. They have acquired this company. Then that company is incurring loss, and packaging is their main income if so, and it is if they sell that packaging a part to others, if they are doing on behalf of the my parent, then for the parent is a direct cost, and for me it's an income. Then for as a group, they can reduce their tax liability by using this loss-making company in the non-arm's length pricing. Okay, then therefore it's exposure to transfer price in years. Then in the transfer pricing gazette notification 2217/7, in the transfer pricing gazette notification 2217/7, under that, under the regulations 1, the para 3 satisfied. It's a ABCO, it's a para wise, it's going, it's a, para C satisfied. Paragraph C, it's satisfied. Okay, it's satisfied. Then it has the exposure to transfer pricing. Then the second one, which it has asked, the then second one, ability to claim of income tax refund, the section 150. Then in section 150, which is refunds, section 150, what it has given for the refunds, then which is without an audit, the 60% of the refund, it can be claimed. If you, let me come to act. Now don't look at this act as something like miracle, and it's a consolidated act. And for the easy reference I'm using, but for the practical, you have the consolidated act. No, we are using the amendments and the main enactment for the application, and this is one of the easy reference for us. And the madam, it has done for the own betterment of the all of the people who are in the tax and non-tax. Then therefore we are using this. It's one of the humble, which is it's a highly benefited for us, the activity which has done by the madam. Then we are using this in practically. Then for this, which I really need to go through this, I'm taking this one. Okay. Then here, which is section 150 subsection, here we go. Then in here, section 150 refundable amounts, in that it's very clearly given this one where the amount of tax which has been paid to taxpayer exceeds the amount of the assets, then it's a refunded. The refundable amount, how it's a interest and that things are there, but this is the new thing, which is from the application from the amended Act number, which is one of the Act number, rather than the, it's a Act number 4 of 2023. Yeah. Then the request of the taxpayer set off 60% of the refundable amount against the subsequent income tax payable by the taxpayer prior to a audit of the refund claim. Then therefore, now in this question Lamai, the main thing which you need to look at in question 3, there is a change in of control happen. Okay. which is the application of the section 64. Application of section 64, changing of control. Which is the shares 50% or more, it has changed when compared to the previous 3 years. Now today, the structure ownership is going to change. And as per given information, this company as same as this. It's the continuing. Then it's a therefore this restrictions given under application of the change in of control, it's not applicable. Please go through change in of control. Even in the preceding discussion I have done this. Then this is change in of control, but the restrictions are not applicable. Then for section 150, which is for refunds, this change in of control not applicable. Change in of control, it's not applicable, but it's applied the section 150. In section 64, it's not applicable. Section 150 applicable. Accordingly, the company upon the request, the refund, upon the request, the maximum of 60% can be claimed as refund without audit. Without refund audit. The refund, now in the SWAT also there is a risk-based refund mechanism they are going to. It is in the way of implementing, not going to, it's a way of implementing. Then without doing the audit, 60% you can claim. And the next one, what is asking, which is here, return filing due date, then you know it's a return filing, it's in the section 93 of the Inland Revenue Act. Then I'm not going to take all these things because these are very easy, which is on the return filing due date, which is 8-month provision. Return filing due date, it is the application of the section 93 of the Inland Revenue Act. Yeah, in the section 93 of the Inland Revenue Act. And for the time bar provision, which is a 30 months from the, for that, please understand very clearly, the return has filed on 15 December 2024. Then the time bar provision will be applicable from the date of the return submission. It's not from the 30th November. The time bar provision, it will be applicable from the date of the return submission. Then under section 139, under the amended or additional assessment, section 139, it's for the administrative review. Then wait, it's 136, if not mistaken. Then 135, the amended or additional assessment. Then very clearly, accordingly, from the date of the return submission, time bar provision, the application in section 135. Then please note, it will be applicable from the date of the return submission. From the date of the return submission. Okay. Then within, from the date of the return submission, the 30 months applicable. And what's the next question it has asked? The penalty application on the non-filing of the return, which is the, again, section 176. If the penal provisions are there, then you can refer to that. Yes, in the penalties in section 176. Then in penalties applicable, then the section 176. Okay. Only it's asking for penalties applicable on return submission. non-filing or late filing of the return. Okay. Then under that, for non-filing or late filing of return. These are the areas which you all can earn marks from the open book referential materials. Okay. Now entire paper we have discussed. Then entirely 100 marks paper it has discussed. And now let me come to your questions. Then the case law. Yes, Rameswara, it is the case. And if the year of assessment is on 31st December 2024, CIT fine in 8 months will be on 30th August 2025 or same. It's a general. It's a general way, 30th November. It's not, it is on a financial year. It's not a change in of the year of assessment. Even for the financial year ending 31st December 2024, no change to year of assessment. It's a year of assessment 24-25. Then it is which we need to go with the financial period different, year of assessment different. In the section 20, it has very clearly given how we are. It's a company and the trust is can change the year of assessment, but in particularly in the financial period difference is not the change of the year of assessment. If so, the banks, everything is changing, then this is not a change in of the year of assessment. And next question, which is what is in here? If any delay in CIT return submission, time bar provision is not applicable. Mandang not applicable. Daru, it's applicable. Come to section 135. It's a, if I thought, okay, I'm not going to discuss that and I'm ignore that, then again the questions are there and I cannot close my eyes and complete this. Then come to section 135, come to this. Then in here, the application of them, come to this. Subject to subsection 3, I'm just coming to this 135 subsection 5. The assistant commissioner may amend the tax assessment and all these things given. For a self-assessment, the date that it's given in any case, in any other case within 30 months. Now how the 30 months will be applicable? For the self-assessment, the date that the self-assessment taxpayer filed the self-assessment return for which the self-assessment relates. Is the, not I am telling, this is a law. Okay? Then that is for your question, that answer. And sorry, then which the next one, isn't it? No, it's not like that. This is the provision. You must be tired. Yes. Thank you for doing this for us. Then thank you. Then for CIT can issue amended assessment within 30 months only if they file the return. Yes, Lamai. This time bar provision is applicable only for the person who has filed the return. And again, even for the default assessments, even for advanced assessments, then for these things, that's why it's given in any other cases. One part is applicable for the if we have filed the return. Then other part, if the assistant commissioner has sent the notice, then from that notice time it is applicable. It is for the amended or additional assessment. Originally, the time bar provision 30 months, it will be applicable from the date of the return submission. Then now what your question you have was, it's a delay CIT return submitted. Already delay unaddaru, you have submitted the return. Then from that day, time bar provision applicable. That's the law. It's not the 30th November. That's what I have mentioned. Then okay, I think I can now leisurely stop. if not, it's a 10 minutes for being okay. Then if it is useful for you all, then I'm so happy. Then thank you for being interactive with me as the which is the Chamat main intention make me awake. Then it was successful. Then please, which I really need to tell, for your exam, it is only 3 hours, 15 minutes for plan your paper and read a question and plan with that 15 minutes for one question, and please do the things in necessary manner. Have your all open book referential materials with you, and which is next thing, if the one question, if you don't know, if it is difficult to you, don't be in that question and go for next question and allocate your time accordingly. Do the past papers. It's a critical success factor for you to pass the exam. Look at the examiner's comments, because examiner has mentioned what are the weaknesses you have done, not you, the previously the students done. Then therefore it's give a immense value for you. Then and past papers and these things, and please know the syllabus as it is for the 100% for your exam. Okay, now let me conclude the session, and thank you very much being the interactive participation. And again I must pay the gratitude for the CA Sri Lanka by organizing this one education division, and to the knowledge sharing for the students, and for thank you very much for that opportunity. And let me now conclude the session. Wish all the very best for your upcoming exam and for all the things on behalf of you. Then good night for all of you.